private chat. What is your debt service? Let's see, private chat. What is your debt service? Good morning. So your debt service, and I appreciate y'all's honesty. Thank you guys. So your debt service consists of two pieces. When you hear the word debt, isn't that money that you owe? So when we think of debt service, we're referring to your principal and your interest. Principal is the amount of money you borrow from the bank. Interest is what you owe the bank for borrowing the money. That's what you're indebted to them. So your debt service, and a couple of you are saying PITI, and you're halfway right. The TI is not part of your debt service. The TI is your taxes and insurance. That goes towards either the county or the homeowner's insurance company. You guys with me? That's not debt you owe to the bank. That's just like your bills. So your debt service is your two parts, your principal and interest. Again, it's what you owe the bank. Good morning. So we are in the throes of financing. We got through unit 14 last week, and now we're going to jump into 15. Remember, I do think one of the best ways for us to get through the financing units is to put our lender hat on. So shake out your lender hat from last week and go ahead and tuck it on, and let's think like a lender, not like a real estate agent, but like a lender. And so last week we talked about principles of financing. So now in unit 15, we're going to talk about the more in practice. And this is the more practical unit for us as brokers, because this is what we can do to help lenders get the buyer through the loan approval process. And please hear me when I say it is a process, that loan approval process. And there's a really good chance your buyer might call you and ask you some questions. And we can help them with some general information. But bottom line, we probably want to direct our buyer to the lender so they can answer their questions specifically and directly. But again, we're just getting a very basic understanding so we can help our buyers through the transaction. So the in practice, in this unit, we are going to our guide or roadmap, if you will. We're going to talk about the different types of loans. There's conventional loans, there's FHA loans, there's VA loans, there's USDA loans. We have several different types of mortgage loans that your buyers might be applying for to purchase the home. We're going to identify who the players are in the lending game, and we're going to talk about what each player's role does in that lending game. And then we're going to talk about the actual practice and procedures. Now, please understand, the loan to buy a home may be a totally different process for the loan to buy a car, or a loan that you walk into the bank and need money to pay off bills or whatever. So we're just focusing on residential mortgages, those practices and procedures. And then, as promised with financing, we got some math. We're going to help you at the end of this unit. We're going to learn how to calculate our monthly principal and interest, our monthly debt service. And then we're also going to do some math to help qualify our buyer. Again, just a basic understanding. If the lender's not available, maybe the lender doesn't work on weekends, and your buyer wants to see a property on Saturday, we want a very brief method to determine if it's worth showing that buyer that home. So we'll talk about that math for qualifying a buyer. So this unit starts on page 390 in your book. And we briefly mentioned the housing market crash last week. The housing market crash was bad. We're gonna see a little bit more about it this week. And a lot of the lender laws that we have in place today are meant to keep us out of the housing market crash again. Now let's understand something. Real estate is a market, and markets always have highs and lows. There's good times and bad times, just like any economic market. So we're going to have lows again. We're going to have bad times again, but hopefully they won't be as low, as bad as the housing market crash was. And that's what these lender laws are now in place for. So a couple things that we got from the housing market crash. We got the Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau, you say that. Consumer Financial Protection Bureau is meant to protect who? The consumer when they're getting a mortgage loan. So let's all understand something right now. In lender world, when we're talking about the consumer, we're talking about the borrower. In real estate, the seller is the borrower of their loan, right? When they bought the house last year or 12 years ago, they got a loan and they're the borrower. You also have the buyer, that's the borrower of the loan that they're trying to get. So when we talk about the consumer, we're talking about the borrower. Specifically with this discussion with 15 and then on into 21, we're going to typically think of the consumer, especially with all these protection policies that we have in place, as the borrower. TRID, which I'll talk about in just a second, the CFPB, they were designed to protect the consumer, and the consumer in this transaction, is the buyer, because they're the ones originating a brand new loan. Everybody with me? They're going through that process to get loan approval, and fingers crossed we get approval and they could go on to buy the home. So the consumer that we're protecting in this transaction is the buyer, the borrower, because they are originating a loan. The other thing we got from the housing market crash, again, to hopefully prevent us from going low again, as low as what we did, something called TRID. You don't need to know that date, but look at how young TRID is. TRID is a baby, isn't he? TRID's getting ready to turn like, what, 8? So in the big picture, TRID's not been around that long. Good morning. So let's talk about what TRID is. You guys have figured out by now that real estate is an industry of acronyms. So TRID is like the acronym of all acronyms. TRID, the acronym TRID stands for TILA RESPA Integrated Disclosure. TILA is an acronym for the Truth in Lending Act. RESPA is an acronym for the Real Estate Settlement Procedures Act. So what TRID did, understand, TILA's always been around, RESPA's always been around. What TRID did was combine them. They integrated them. Each had their own paperwork. TILA had paperwork, RESPA had paperwork, and quite frankly, they were awfully similar. Consumers thought that they were signing the same document twice in some cases. They were saying, oh, this is a duplicate. I've already signed this. So TRID said one thing that we can do to help protect the consumer is modify the paperwork, modify the required disclosures. Now, TILA and TRID do two very different things. We're going to talk a little bit more about TRID in this unit. I'm sorry, TILA in this unit. Unit 21, we're going to talk a little bit more about RESPA. I'm not getting too in depth with either of them, but again, that basic understanding. TILA tells the consumer the cost to obtain the loan. When you see the word TILA, see the word lending. TILA tells the consumer, what's it going to cost you to get this loan? What's the truth in getting this loan? RESPA tells the consumer the cost to close. When you see RESPA, see the word settlement. So TILA helps the consumers obtain the loan. How much is it going to cost? We're going to see in just a bit. Lenders have to give full disclosures about costs for getting the loan. And then RESPA steps in and says, okay, you got the loan. Now how much is it going to cost you to get to closing? Unit 21 is when we go to closing. So that's where we'll spend more time with RESPA. So we will see this again. So let me introduce you guys now to the players in the lending market. There's three different players, or three different tiers, if you will. One thing we talked about last week was the lenders that we are getting money from to buy a home, to get a mortgage loan. Those lenders don't have an endless supply of money, right? They don't have a money tree out back that they can just go pluck you $100,000 bill off and say, here you go buy a house. So lenders got to get the money from somewhere that they lend to you. And that's where this conversation is heading, by talking about the players and where each player in the financing market gets the money. So the top tier, at the very tippy top of the players, is the Federal Reserve System, also known as the Feds. The Feds help regulate and control our economy. Again, the economy is a market, so you have to allow for fluctuations. There's got to be highs, there's got to be lows. The Fed's, part of the Fed's responsibility is to try to prevent the highs from being too high and the lows from being too low. Again, that's why we have a lot of lender laws in place now after the housing market crash, because we don't want to wind up that low again. So that's why the Fed stepped in and regulated the money, regulated the mortgage lending practice. So they are the ones that control the economy, and that does include the mortgage lending. Some lenders will borrow money from the Feds. They borrow money from the Feds, and in turn, they lend it to you to go buy a house. So some lenders get their money from borrowing it straight from the Feds. Do you guys think the federal government is going to charge a lender to borrow money from them? Well, yeah. So the federal government charges them interest. So that's part of where our interest gets passed on to us. They don't want to absorb that cost. They may not charge as much, I honestly don't know, but there is a charge for lenders to borrow money. So this is one option that they have, is to borrow money straight from the Fed, straight from the top. The second player in the mortgage lending game is the primary mortgage market, and that's who you and I talk to. When you want to borrow money, when you want to go buy a house, you borrow money from a player directly from the primary mortgage market. The primary mortgage market players are the ones that originate our loans. And they make their money by charging loan origination fees, maybe some discount points. There's several different sources they can make their money from. Some lenders in the primary mortgage market, once they originate the loan, once they give you the money you need to buy this house, some will keep it, service it in-house, and you pay them directly. Most sell their loan to other lenders. Now let's talk about why they sell your loans. I've had buyers before, we go to closing, and within the first week of their home ownership, they're getting notified that their lender sold their loan. And they're like, their little feelings get so hurt. And they're like, I thought my lender liked me. No, your lender loves you, but they got to sell their loan, your loan, to keep money in their pool. So let's say there's a player on the primary mortgage market, and the player has money. They got money. I don't know where they got it from, but they have money. And they have enough money to give a loan to you, and you to go out and buy a home. And once they give those loans, they have no more money. So one way for them to make money is to sell your loan to somebody else, which replenishes their funds and now allows them to give a loan to you, and you. Does this make sense? As long as they have funds, as long as they have that money, and maybe selling it is cheaper for them than buying more money from the feds. And that's where it depends on each lender. Again, some will service your loan. In the mortgage world, when we say service your loan, we're saying they could sell it. They sell it to another lender. So don't take it personally. They're just trying to keep their funds replenished so they have more money to issue. Help keeps the economy going. I mean, you think about some of those dollars in real estate, some of that money that goes around in real estate, we got to help keeping that money flowing. So the primary mortgage market, again, this is who you and I talk to. When you wake up and decide you want to buy a house, one of the first things you need to do is call a lender. This is who you're calling, as somebody on the primary mortgage market. Once your loan is originated, the lender may sell your loan to a player on the secondary mortgage market. And this is our third tier. The secondary mortgage market is who buys loans from the primary. So they can replenish their funds, so they have more money to lend out. So the secondary mortgage market buys loans from the primary. And that's when you, as the homeowner, get the call saying your loan has been serviced. Your loan has been sold to a player on the secondary mortgage market. The secondary mortgage market players have names. You may have even heard of some of these names. Oops. The players in the secondary mortgage market, Fannie Mae is a player in the secondary mortgage market. Fannie Mae is the oldest. She's the biggest. Fannie is the hungriest. Fannie will buy them all. If it's a mortgage loan, Fannie's going to buy it. She's been around the longest. She probably has the most funds, the most resources. Again, we're going to talk about conventional FHA and VA in just one second. But Fannie buys them all. Another player in the secondary mortgage market is Ginnie Mae. Ginnie's a little bit more particular. Ginnie's only going to buy FHA and VA loans. Now, one thing we're going to learn in just a second is that FHA and VA loans are government loans. So one way I remember this is that Ginnie buys government, GG. Ginnie buys the government loans. Who are the government loans? FHA and VA. Again, we will talk more about that in just a second. So Ginnie buys the government loans. And then Freddie's the most picky of them all. Freddie's only going to buy conventional. So Fannie buys them all, Ginnie buys government, Freddie buys conventional loans. I think you guys should make a note. Pages 394 to 395 talks about the housing market crash. Please don't try to read it now, but make yourself a note. It kind of gives us a little an idea of how things were, how low things got in the housing market crash. Again, studying this may help us better realize why we are where we are today. So I'd make yourself a note to read that. I'm proud to say I lived through the housing market crash. I wasn't in sales yet. I was still an admin. But even as an admin, I mean, times were tough. We got our hours cut. I mean, one of the first things I did every morning was go to work and see who cleaned out their office or cubicle from the night before. We had them dropping like flies. And I knew my broker in charge would want to know who was here today that, is not here today that wasn't yesterday. So it was bad, you guys. It was tough. But we got out of it. I sometimes feel like I should have a t-shirt. I survived the housing market crash because it was tough. It was tough. And again, we're going to have lows. We will have lows. But hopefully those lows won't be as low as what they were. Any questions so far? The players of the market? let's introduce you to a couple of the more common mortgage loan types. Obviously, there's more than what we're talking about. The more common ones that we see. First up, we have conventional loans. Conventional loans are not backed by the government. The government does not offer a safety net to the lender. Why would the lender need a safety net? What if the borrower defaults? What if the borrower stops making payments? The lender's out of that money, right? They've possibly lost money. And the lender's not going to support, the government's not going to support lenders with conventional loans. The lender bears all the risk. So in other words, if the borrower defaults, it's all on the lender to try to recoup their money, try to get that money back. Conventional loans are typically conforming or non-conforming. Non-conforming loans just meet certain bank requirements. We're not getting into those specifics. Conforming loans just meet certain bank requirements. And if these bank requirements are met, then they're sellable on the secondary market. So if a lender wants to service their loan, if they don't want to keep it in-house, then it needs to be a conforming loan so they can sell it to a player of the secondary mortgage market. Non-conforming loans then don't conform to certain bank requirements and are not sellable. These lenders would keep these conventional loans for non-conforming. They would keep these conventional loans in-house. They would service them themselves. So they make their money by you paying them every month. For the next 30 years, it'll take them that long to get their money back. Because the lender bears all the risk, the lender may charge for a conventional loan, PMI, also known as private mortgage insurance. Do we see the word insurance? The lender is charging you insurance to protect themselves because they don't have that safety net, that government safety net. Typically with PMI on conventional loans, we're going to see PMI when the loan to value ratio is 80% or more. Remember, the loan to value ratio is through the lender's eyes. Of the value, how much loan do you want? Loan to value ratio. So if that loan to value ratio on a conventional loan is 80% or higher, the lender will typically charge PMI. It's a percentage of the loan. Lenders all have their different rates. And once, as a borrower, once you get that loan payment down to less than 80%, 79.9%, then typically they will drop the PMI insurance. So they're only going to carry that insurance. Because let's think this through. Let's say, you get a loan for 80%. Your loan to value ratio is 80%. So your loan to value ratio is 80%, which means you're bringing how much? If you're asking the lender for 80%, how much can you bring? You got to bring 20, right? Who has the bigger interest in this? I mean, your little 20% is cute, but who's bringing the money for you to buy this house? Isn't it the lender with the 80%? What if you have more money and now your loan to value ratio is 60%? Now, how much are you bringing? If the lender's bringing 60, you're bringing 40. Don't you have an even more interest in this now? And the lender has a less interest. So that's where that 80% is the threshold. The lower the loan to value ratio, the less risky it is to the lender. Let's see, can you talk more about selling on the market? So I don't know specifics, but what I do know is the players in the secondary mortgage market, Fannie, Freddie, Ginnie, will buy loans from Wells Fargo, Bank of America, Fairway Mortgage, Movement Mortgage, right? Any of our mortgage lending companies. And then you and I, the borrower, will send them, they will collect their money from us through our monthly payment, because now we're paying them each month. So now they're getting that interest payment on the principal. When the primary lender sold their loan, there's charges and fees involved in that. I don't know what all that looks like, but there's charges and fees. The lenders are going to get their money. Don't worry about them. But once they sell the loan, they're no longer getting that monthly payment from you. And that's why they're selling that, is to replenish their funds so they can originate new loans. So conventional loans, the lower the loan to value ratio, the less risky you are to the lender. Remember, the loan to value ratio is through the eyes of the lender. If you march in the bank and say, give me 100%, don't you better have good credit and good credit history and reputation? Otherwise, the lender's going, right? By the way, we're not seeing many 100% loans anymore. We did prior to the housing market crash. It was so easy to get a loan prior to the housing market crash. It's kind of like Oprah was giving them out, right? You get a loan, you get a loan, you get a loan. Everybody got a loan. It was that easy. All you had to do was call who and loan, and you got a loan. And then everybody stood there and said, why do we wind up in a housing market crash? Oh, I know. So, we learn, we live and we learn sometimes, right? Now, I don't want to give lenders a bad reputation because, guys, honestly, there's a cajillion theories out there about why we wound up in the housing market crash. The lending practice was just one theory, and not all lenders operated that way. Some lenders still did things right. So I certainly don't want to give a bad reputation to the lenders. So for our PMI, just an example, the property appraises for 100,000. You ask for 90,000. Loan to value ratio. Remember our loan to value ratio. Loan to value ratio. So when you take the loan amount of 90,000, divide it by 100,000, through the eyes of the lender, the loan to value ratio is 90%, which means you're only bringing 10. You're asking the lender for the rest. So as we said, you're putting down 10%, you're bringing your little $10,000. The lender's probably going to charge PMI insurance because the loan to value ratio is more than 80%. Again, most lenders, once you get below that 80%, once you get below that threshold, they will drop the PMI because you're just not as risky anymore. So conventional loans. Conventional loans are not backed by the government. Another loan product is an FHA insured loan. Now let's understand something before you start writing. Let's understand something. Lenders have the right to set their own terms. Lenders have the right to set interest rates and term repayment terms, and right, they can set all their own limits. So the government, the FHA, does not control the lender. They still allow the lender to originate the loan, approve it if they want, set their own interest rates. The FHA insured loan only insures the lender in the event of the borrower's default. The FHA insured loan offers a safety net to the lender. And what the FHA insured loan says, if the borrower defaults, we're here to catch you. We're here to help bail you out. Doesn't this sound better for the lender? They have a safety net now. They have somewhere to fall. Is the FHA and the lender going to go after the borrower, the defaulting borrower? Probably, but they're just not as risky. So lenders set their own rates and fees and terms. They're still all allowed to do that. The FHA does not offer insurance, homeowners insurance. That's a common misconception. We see the word insurers and things are going to insure your property. Understand, the FHA is only insuring the lender. They're offering a safety net to the lender in the event of the borrower's default. FHA loans apply to residential properties, 1 to 4 units. Anything over 4 units, you cannot get an FHA loan. FHA does require owner occupancy in one of those units. So if you're buying a duplex, for example, you got to live in one of the units in order to qualify for an FHA loan. The FHA loan charges a MIP, or a mortgage insurance premium, MIP. This is just a one-time fee charged at closing. This is kind of like their origination fee. The lender will still charge a loan origination fee, but there'll also be a MIP to help with the costs. FHA loans are not going to be approved for all properties. FHA loans, guys, let's be honest, the government's involved now. Are there more hurdles to jump? Yeah. So in an FHA loan, not only do the people have to get approved, but so does the property. And not all homes are going to qualify for an FHA loan. Part of the reason for this is your loan to value ratios typically tend to be much higher. Last I heard, do not quote me on this, you obviously won't be tested on this, but last I heard, FHA loans were offering a loan to value ratio of 96.5%, which means you're bringing how much? 3.5%. We just talked about how cute your 10% is. 3.5% is even like more cute, right? So one way that with these high loan to value ratios, again, they can do this because we have the government offering the safety net to catch the lender. But then they also allows them to have tighter restrictions on the property. So the property has to have an approved appraisal, an FHA approved appraisal. If, for example, I don't know, the roof is 45 years old, you may not get FHA approval because the FHA is going to say, whoa, this is a 45-year-old roof. This thing is going to need to be replaced soon. I'm just giving you 96.5% of the loan amount. How are you going to get the money to put the roof on soon? You guys with me? So major repairs. One thing that I personally ran into with an FHA loan was chipped paint. The house was built prior to 1978. They would not approve. It was outside paint, by the way. It wasn't even inside. We had to get that taken care of. But my point is that the appraisal process is much stricter. Not all properties are going to pass the FHA approval. When you guys get out in practice, when you guys get out and start working with buyers and sellers, and you pick up this buyer that's going for an FHA loan, you can go to the FHA's website. Please don't do it now, but you can go to the FHA's website and they'll give you a list of things that they may not approve. So when you're with that buyer and you're going through the home, you can say, well, gee, there's chip paint and that roof looks like it's getting ready to cave in, and there's termites. So I don't think the home will pass FHA. This is one way that we absolutely can help. FHA loans, they can't charge a prepayment penalty. We talked about that last week in Unit 14. And then FHA loans can be assumable, which means the buyer can assume the seller's loan. If the buyer assumes the seller's loan, they are taking on the payments. They are just taking over the payment straight from the seller. One reason why a buyer might want to assume a seller's loan is going to be a great example in a couple years as we're coming out of this other crazy market with historically low interest rates. Last year, 2 years ago, interest rates were being originated at 2%, 3%. I mean, that's just phenomenal to get a house loan for 3%, a mortgage loan for 3%. I think when my parents bought their house in the 80s, it was like 13% or something absurd like that. So 3%, 2% is just crazy. So now we have these loans being out for 2%. Let's say you're a homeowner and you bought your house last year and got an interest rate of 2.8%. And fast forward 5 years, 10 years, and you want to sell your house. If your loan's assumable and the guy across the street is selling his house, But to buy his house, you have to originate a new loan at 8%, 9%. Which loan product looks better? The assumable at 2%. So the buyer could assume the seller's loan. Now, obviously, they got to still come up with the difference. What do I mean by that? Let's say the value of the home is $100,000. That's the value. The seller has an outstanding mortgage of $50,000. That's their mortgage. So you're still going to have to come up with money to bring the seller at closing. You're going to give the seller $50,000, and then you're going to take on their $50,000 debt. And that's what we mean by assumable. And again, where we're going to see, my crystal ball says we're going to start seeing this more and more as interest rates are, we're already back up at 6 point something, which, by the way, is not terrible, but it ain't no 2 something, is it? So I think as we see these start to come up a little bit, we're going to see this more and more. I got lots of cameras off. I'm looking at lots of ceilings. Can we please be here? So FHA insured loans. We also have another loan product. It's called a VA guaranteed loan. Again, the government is guaranteeing the lender in the event of the borrower's default. The government is guaranteeing the lender. Yeah, yours is on now. You're good. Simple log out, log back in, huh? So the VA loans come from the Department of Veteran Affairs. VA loans are set aside for our eligible veterans and their unremarried widow and widowers. So eligible vets and their unremarried widow and widowers. Now, not all vet is going to get a VA loan. They still have to go through the approval process. This is what we mean by eligible. VA loans, again, they're guaranteeing the lender in the event of the borrower's default. They're offering a safety net to the lender, and they're saying, if this borrower stops paying, I'm here to catch you. I'm here to help bail you out. It also applies to 1 to 4 units. One of those units has to be owner occupied in order for approval. And with VA loans, with the eligible vet, this might be where we see, check that out, 100% financing. What a nice program for our vets. Help get them in their own home at very little cost to them. The VA does charge a funding fee, again, in above and beyond the loan origination fee and the discount points, but they do charge a funding fee just to fund the loan. A lot of the times, if the vet's eligible, the VA will allow the vet to roll their funding fee into their mortgage. So in other words, now their loan to value ratio might be more than 100%. They allow them to roll those costs in. Again, they got to be approved, but they'll allow them to roll that into their mortgage and to make payments on them over the course of the term of the loan. Each eligible vet is entitled to 1 certificate of eligibility. And the vet can only have 1 certificate of eligibility at a time. So if they have a certificate of eligibility out, they can't get another VA loan. If they want to buy another property, if they want to, we're going to see in just a second, it can be assumed. Once that certificate of eligibility is out there, they can only have that one. So if a vet has a certificate of eligibility on their home and they want to buy another property, they're going to have to go conventional or FHA. Does that make sense? They're going to have to go a different loan product. 1 certificate of eligibility at a time. VA loans also have strict appraisal processes. Again, not all homes are going to qualify for a VA loan if there's lots of work that needs to be done. The appraisal process with the VA loan is referred to the certificate of reasonable value. So this determines how much the home is worth and how much the lender can lend. Guys, we're talking 100% financing here in some cases, even more hurdles than the 96.5%. So certificate of eligibility or reasonable value is the appraisal process. And again, it's really strict. I had buyers once go on VA and they were buying a flip, which is fine. The VA doesn't care about that. Everything's new, right? So it's in good condition. And the guys, I mean, they had all their permits and certificate of occupancies. They had everything. I'm sure that's one thing the VA cares about. But when the appraisal went to the home to do the appraisal, the appraiser went to do the appraisal. I guess we just hadn't gotten there yet. But you know all those plates that cover your light switches and your wall outlets? Yeah, they hadn't gotten those up yet. And the appraiser denied the FHA, the VA loan. They said, we're not going to issue this loan until you get those plates up. What do those things cost? Like 27 cents at Lowe's, right? You know, yeah. So our closing was delayed because our flipper, which was going to do it anyway, he just hadn't gotten there yet, had to go out, get those plates, and then we had to reschedule the appraiser to come back out. I said, can I take pictures? Can I send you a video? And they were like, no, he needs to see it for himself. Okay, our closing was delayed a couple of days. Remember we said, always have a plan B because you never know. But I get it. You know, let's think through the eyes of the lender. You got open circuits, right? You got open wall units. Don't kids and pets like to stick their fingers in stuff, right? Sniff stuff and touch stuff. So, you know, it's a safety issue. They were going to do it. They just hadn't gotten to it yet. It's just a tighter appraisal process. The home has to qualify. The people have to qualify. If you guys remember back in Unit 8, we introduced you guys to the listing agreement, our exclusive right to sell listing agreement. And one of the conversations we have with the sellers is the loan type that they're willing to accept. Is it a conventional loan, cash, of course? Is it a conventional loan, FHA, VA? So again, listing agents, we can go to the FHA's website. We can go to the VA's website and see things that they're not going to approve. And when you're sitting at that listing appointment with the seller, we can say, this 45-year-old roof is not going to get FHA or VA approval, so we're not going to accept that type of loan. Does that make sense? This is a conversation that can start with the seller, but buyer's agents, we have an understanding of this as well. Again, you can go look at lists. Chip paint prior to 1978, they're not going to approve it until it's taken care of. Evidently, light switch cover plates, they're not going to approve until it's taken care of. The VA loan also can be assumed, but check this out. The VA loan can be assumed by anyone. You don't have to be a vet to assume a VA loan. The buyer still has to be approved. The borrower still has to be approved. They have to go through the process. But remember, the vet can only have one certificate of eligibility out at a time. So if you have a certificate of eligibility and you allow somebody else to assume your loan, you won't get another certificate of eligibility until that gets paid off. But the VA loan, if applicable, can be assumed by anyone. Once that loan is paid off, then the vet has a restoration of entitlement. Their certificate of eligibility, they'll probably have to get reapproved. I'm sure their credit terms have changed from when the last time they got their certificate of eligibility. But once it's paid off, they have that restoration of entitlement. And then the VA also cannot charge prepayment penalties for paying it off early. Now, you guys may remember in Unit 10, we introduced you to some addenda. And one of the addenda we introduced you to, we can go back real quick, go back to page 293. Hold your place in the book. And let's go back to page 293. One commonly used addenda we have is the FHA VA financing addendum. So if you're a buyer's agent and your buyer's getting an FHA or VA loan, then this is an addenda that we need to include. This is a form that we need to include with our offer. And this form does two different things. The first thing this form does is it protects the buyer's earnest money if the property doesn't appraise and they choose to terminate, even if this is after the due diligence period. So the addenda protects the buyer's earnest money if it doesn't appraise. The other thing that this addenda does is specific to VA loans. There are certain inspections that the VA will require. The VA will require it. For example, one inspection that's required is the pest inspection. A vet cannot buy a home with a VA loan and not have a pest inspection. But here's the kicker. The VA requires the borrower to get the pest inspection, but they don't let the borrower pay for it. So if the buyer's not going to pay for the home inspection, the pest inspection, who's left? Who's the other part of the transaction? Now the seller's got to pay for it, right? As a listing agent, do you think that's important to share with your seller when you're presenting the offer? You may be on the hook for the pest inspection if you accept this offer. If the property's on a well, they might require a well water inspection. If it's on an on-site septic system, they might require a septic inspection. And some of these, if required, the expense may be borne on the seller. So that's what this addendum does. It protects the buyer's earnest money, and with a VA loan, it lets the seller know you may be on the hook to buy these things. If the seller gets an offer for a VA loan, what are their three choices? They can accept it, reject it, or counter it. So I know you guys like to get upset. Do they have to pay it? No, they can reject the offer and walk away. You guys with me? We can renegotiate the purchase price to up the price in the seller's mind to cover those costs. You see where we're going here? We just know that the VA won't let the borrower actually write a check or pay online themselves. It's got to come from the seller. I don't know why, but. Questions on VA, FHA, VA? Again, you guys, the government's offering a safety net to the lender. The government's not guaranteeing that the buyer will pay them back. The government's just offering the safety net to the lender in the event of the borrower's default. Another loan product we may encounter, not as common, but it is still out there, is a USDA loan. What do y'all think of when you hear of USDA? If you just thought of a big juicy steak, you're my kind of people. This is our farm loans, isn't it? This is our farm. So the USDA loans are for farmlands, rural areas. You are not going to get a USDA loan in downtown. So USDA loans are for rural areas, help support our farmlands. They may also offer loans to non-farms, just single family loans in rural areas. That's the key. It's got to be a rural area. So maybe it's a farm, maybe it's just a family home. It's rural. So to be eligible for a USDA loan, it's got to be a rural area. Their whole point is to provide families with safe and decent housing, and particularly to help low-income families in rural areas. If you're working with a buyer that wants to go for a USDA loan, first thing you're going to want to do, please don't do it now. The first thing you're going to want to do is go to USDA's website, because what they will give you on USDA's website is a map. You plug in the address of the property that you want to see. If it falls in the yellow shaded area, it's not eligible for a USDA loan. Why are you going to go show that property? If it's outside of the shaded area, and you can see here, this is Winston-Salem, by the way. We don't get into USDA eligible until we get, I mean, here's Tobaccoville. Check this out, y'all. Rural Hall isn't so rural anymore, is it? The name kind of, they need to change their name. So when you, and this map updates, by the way, regularly. So again, you know, a couple months from now, 2 years from now, when you're working with a buyer that's going after USDA and they say, ooh, I want to see this new listing, go to the map first and make sure it's even eligible. USDA loans, again, to help low-income families and our farms, they may offer longer than normal repayment periods. So for example, instead of a 30-year loan, they may offer a 33-year loan or a 35-year loan. So you have a longer term, which means you can stretch out those payments. Your monthly payment isn't going to be as high. They can offer those that are approved, those that are eligible, very low to no down payment. They'll float the loan. And then they may also offer subsidized interest rates. Subsidized interest rates mean the interest just, it doesn't accrue. It's kind of like a deferred payment. Think about your college loans, for example. You could subsidize or you could defer making that college loan payment until you were done. So the subsidized interest rates aren't going to accrue interest, and they may allow the borrower to defer some of those interest payments. Again, we're just helping low to moderate income families in rural areas. Questions? All right. Let's take 10. We come back, we keep going in unit 15. All right, camera's coming on. We are taking attendance. And jumping back in. A couple other loan products to talk about, starting on page 403. We're going to go through these pretty quickly. Most of them are green. Well, all of them are green stars. So, conventional FHA, VA are the most common ones. The more commonly used one, USDA probably next. And then after that, some of these starting on page 403. So at the top of 403, we see something called purchase money mortgage. Thank you. I have taken attendance. So make sure you tell me you're back. Purchase money mortgage is seller financing. What is seller financing? It's called a purchase money mortgage. What do you think you're going to see on your test? Seller financing is kind of easy, isn't it? So write that down. Seller financing is purchase money mortgage. The seller is selling, but they are also acting as the lending institution. So in other words, after closing, the buyer becomes the owner. And instead of making payments to a lender, to a bank, they're going to make payments directly to the seller. So they're acting as the lending institution. Again, remember back in unit 10, and we talked about installment land contracts. Very similar. Installment land contract, the buyer's paying the seller. They're just doing it in installments. They're doing payments. They're not doing it in one lump sum at closing. So understand, for our purposes, the difference between a purchase money mortgage and an installment land contract is when the deed changes hands. With a purchase money mortgage, the buyer gets the deed at closing. And then they pay the seller like they would any other lending institution. I have taken attendance. So if you want to be counted present for this hour, please let me know you're here. With an installment land contract, the deed changes hands when the last payment is made. So purchase money mortgage, deed changes hands at closing. Installment land contract, the deed changes hands when the last payment is made. Again, we don't have forms, pre-printed forms. So in these situations, we're going to have attorneys involved anyway to help us draft up these forms. I'll address that in just a second. Then, as I said, from pages 403 to 405, a couple other type of loan products. We're not going to spend time on these, just very briefly. They're all green stars. You see a test question, you'll probably get a situation and ask you what type of loan product it is. I would focus more on conventional FHA, VA. Other types of loans, a package loan combines the purchase of personal property and real property. So if you're buying, for example, a furnished condo at the beach, you're buying the unit and stuff, right? So you would do so using a package loan, personal property and real property. A bridge loan is a short-term loan. It's meant to fill a gap from one loan ending to another loan originating, to another loan beginning. It's a short-term loan. Think of a bridge. Thank you for telling me you're back. I don't think everybody has. So do we need to have everybody stay here or something? People aren't listening today. Thank you. So a bridge loan is a short-term loan. It's meant to fill the gap from one loan ending to another loan beginning, maybe a construction loan, for example. A blanket mortgage is meant to cover more than one parcel of land. So for example, if you were a land developer and you were buying multiple parcels of land, you would do so using a blanket mortgage, covering more than one parcel. An open-ended mortgage is your line of credit or your equity. This could be using the property as collateral. So you're using the property you already own, you're getting a second mortgage. So it's a line of credit on the property you already own. Construction loans are financing new construction. Construction loans are really risky for the lender. I mean, let's think this through for a second. You're asking the lender for money for something that doesn't exist yet. You're standing on a hunk of dirt with a dream and a blueprint saying, give me money. Usually with construction loans, the lender releases the funds in stages. So in certain stages of building, certain stages of construction, they'll go out and verify that it's happened. And then when they're there, they will release more of the funds. Oops, sorry. Buy down loans are just a way to lower your initial interest rate. You could have a loan to buy down that interest payment. It'd be a second loan. Home equity loans are similar to open-ended mortgages in that they're also a line of credit. You're using your property as collateral, the property you already own as collateral. Probably the big difference in a home equity loan, these are usually to help pay off large payments. So think like medical expenses. If you have a lot of medical expenses, you might be able to qualify for a home equity loan, borrow against your home, and use that to pay off some of your expenses. And then the reverse mortgage is just exactly how it sounds. Instead of you sending the lender money every month, they are sending you money every month. In order to qualify for a reverse mortgage, you have to have equity in the home. Equity is the money you have invested. Most of the time, people that qualify for a reverse mortgage have the home paid off or close to it. This could be a great program for seniors, help supplement their Social Security. Now, when you go to sell the home, that's that much less you're going to get. So they're not giving you money. They're just letting you use some of your equity a little bit, month at a time. This makes me feel old to say, but have you guys seen the Tom Selleck commercials? He's been the recent voice, if you will, of reverse mortgages. Again, good program for seniors that qualify, that have money in their home. Maybe they don't want to leave their home, but instead of selling it and taking all the money, they can take a little bit at a time until they are going to sell it. So again, different loan types, 403 to 405. Don't spend all your study time on those. Just look over and be familiar. Over on page 405, we talk about mortgage priorities. We've been saying almost since day one that mortgage priorities are in the order in which they're recorded. So if you have multiple loans, for example, who's going to get paid first? Well, the one that records first. So mortgage priorities tells us what order everybody's standing in to get paid back. Your very first home loan, the loan that you use to originate your mortgage, is referred to as your senior loan. The attorney will record your brand new deed, and then immediately after that, they will record the senior lender's deed of trust. That senior lender is your original loan. All other mortgage loans after that are your junior mortgages. So your second mortgage, your third mortgage, your fourth mortgage. So your senior mortgage is your original, your junior or second mortgage, third mortgage, etc. A subordination agreement, if you subordinate, you're putting yourself in a lower ranking. So let's talk about when a subordination agreement would apply to the lender world. If we look at a timeline, let's say you buy a home, you originate a loan. That loan that you use to buy the home is going to be your senior loan. That's your first loan. That's your main loan. If you go apply for a second loan, that's your junior loan. Now, junior mortgages are going to have higher interest rates, are going to have higher terms. They're more risky because who's in line first? The senior. So the juniors are more risky. Everybody with me so far? So subordination agreement is going to kick in if you go to refinance your senior mortgage. If you refinance your senior mortgage, it means they're going to redo it. They are going to re-record it. And now, who's getting paid first? The junior. Does the senior like this? Does the senior happy about this? No. The only way that the senior in this case is going to agree to do the refinancing is if the junior loan agrees to subordinate. If the junior loan says, I know I recorded first, but I still want to get paid first. So if the junior loan subordinates, if they put themselves in a lower ranking, then the senior may agree to do the refinance. Questions? So the junior loan should be paid off? Well, eventually, yeah, you'll pay that junior loan off. But what we're talking about is in the event of default. That's what mortgage priority says, in the event of default. As long as you're paying both every month, you're fine. But if you stop paying, then they default, they start the foreclosure process, and mortgage priorities say we want the senior loan to be first. The senior loan wants to get paid back first, and that's what we're referring to. Mortgage priorities tells us the order that people are standing in to get paid back at the sale of the property. Okay. So let's start talking about some of these lending practices and procedures. We're going to get into the loan application. We're just mentioning it here now. We're going to talk more about the loan application in Unit 21. But for right now, let's understand that the lender has to gather information to approve. The lender has to gather information about the borrower, the property, and of course, the terms of the loan itself. What's the interest rate? What's the monthly payment? What are the repayment terms? This is, when you meet a buyer for the first time, early in your conversation with the buyer, you're going to suggest that they talk to a lender. And the lender is going to look at the borrower. They're going to look at the borrower's debt to income ratio, which we're going to talk about. Bear with me. But the lender can only offer a pre-approval or a pre-qualification at this point. We can't start the loan application process because we just started looking at properties. We don't have a property yet. We don't have a contract yet. So we can only go so far in the loan process until we get a property, until we get your buyer under contract to buy a home. So at first, we're going to start with pre-approval, pre-qualification, which I'm talking more about. This is the loan process. The loan application is one of the big places that we as real estate agents can help our buyers. We need to have conversation with our buyers about the importance of communicating with the lender. If the lender says they need a form, the borrower needs to basically stop what they're doing and get that lender that form, because their process is just that. And they can only go so far in the process. They can't go on if they don't have that form. So one of the best things we can do in this transaction is talk to the buyer about the importance of quickly replying to the lender so they can keep going in their process. Would it surprise you guys if I told you there have been buyers that have delayed their own closing because of their lack of response to the lender? Again, the lender can't do it without them. So we as agents can help keep our buyers working with the lender, get what they need, try to keep closing on time. Another thing that we can do as agents is have conversations with our buyers about not opening new accounts, not changing their debit, not changing their credits. Again, do you guys know how many times buyers want to go out and celebrate the contract of their new home by buying a brand new car? They want a new car for the garage. If they have to fund the car, they may now not get loan approval. They may not get the home loan approval. So they have a new car, but they find out their loan's denied. So one of the biggest things we can do as agents is help our buyers understand that they can't open new accounts. They can't go out and get another loan. They can't run to Rooms To Go and open a new account for new furniture. They can do all that after closing. Does this make sense? I had a lender explain it to me once. When you get the contract and the loan process officially begins, the lender takes like a snapshot of the borrower's debt to income. They take a picture. This is what their debt to income ratio looks like today. And then fast forward through the loan process. Now we're a couple days away from closing. And they take another snapshot of that debt to income. And if the two snapshots don't match, we got a problem. So if they open a new credit card, if they go get a new car, apply for a new car loan, talk to your buyers about this. Guys, I've not had it happen personally, but I know plenty of agents out there that have lost the home loan because they ran out to buy a new car. Even if you pay off, that's right. Sometimes even paying off because your snapshot doesn't look the same, does it? So sometimes we think, oh, well, I'm going to apply for a home loan and then I'm going to pay off all my debt. Your snapshot looks different. And yes, it looks better, but they gotta resend you through the application process. It's a process. It is a process. So if those snapshots don't match from when we go under contract to right before closing, the lender's got some issues. They got some flags going up. One thing, and only one piece that the lender looks at, is credit scores. Now, the credit scores are important, but they're not your end all be all. Your credit score range from 300 to 850. The higher the score, the less risky you are to the lender. What does a high credit score say? What does the high credit score tell the lender? It says you have debt, you know how to manage your debt, right? You pay your debt, you pay your monthly payment on time every time. Missing payments, not making that payment, not making the minimum payment results in a lower credit score. Now, all lenders are different. Some have a set amount, maybe, for example, 650, 625. If your credit score is under 625, it's a real short conversation. They may work with you to get your credit score up. Actually, a good lender will help you get that credit score up so you can buy eventually, but they have their own criteria about what is their minimum. So this is only one thing that they look at when approving for a loan. Another thing is your credit history. Credit history. The underwriter, we're going to talk a little bit more about the underwriter, but the underwriter is the person with the loan, with the lender, that crunches all the numbers. They look at all the paperwork. Since the housing market crashed, buyers, they don't leave any stone unturned. They get all up in your financial incomes and debts and money coming in and money coming out. And the underwriter is the one that crunches the numbers and makes sure that the numbers work for this loan product at these terms. So the underwriter is going to look at 2 years of your credit history in detail. They may go back if they have reasons, if they have flags go up. They may go back further. They're going to look at your 7-year history of repaying. How good have you been at repaying in the last 7 years? If the applicant has some kinks in the past, if they have some glitches in their credit history, the underwriter may make an exception, maybe a death of a spouse, a divorce, major medical issues, that kind of thing. They may make an exception if the applicant can show why their credit history is less than desirable. And applicants that are consistently late, that have a history of being late, are probably not going to get FHA, VA loans. They may have higher terms for conventional. At some point in the loan process, the lender and the borrower are going to agree on this day at this time to do a rate lock. And once we do a rate lock, we are locking in your interest rate. If we lock in your interest rate today, by the way, these things fluctuate daily. So if we lock in your interest rate today, that's going to be your interest rate for the term of the loan. Is that 30 years? Is that 15 years? If you lock in your interest rate today and it goes down tomorrow, you're already locked in. If you lock in your interest rate today and it goes up tomorrow, you're already locked in. So at some point in the loan process, that interest rate needs to get locked in so borrowers are aware of their interest rate for the term of the loan. Let's take our lender hat off for just a second and let's bring us in. What do we need to know? Why do we care about financing? I hear you guys. Why do I care, Julie? Well, the Real Estate Commission says that we should care because we should have a basic understanding of how lenders decide whether or not to approve. Again, I'm not a lender. I'm not in lending school, but we need this basic understanding, which is why we're covering what we are in units 14 and 15. When we're working with your buyers, you guys, we are the front lines a lot of the times. What do I mean by that? Your buyer's going to call you first. So if we have basic understandings, we can help move this process along. One thing that we can have a basic understanding about is pre-qualifying a buyer versus pre-approving a buyer. Now we're going to do some pre-qualifying a buyer math. If your buyer wants to be pre-approved, then we need to get them to the lender, obviously. But the pre-qualification is like the first step in the process. And with the pre-qualification, the borrower calls the lender and says, this is how much money I make a month, and this is how much debt I have. And based on what the borrower tells the lender will crunch the numbers and issue a pre-qualification. They don't verify it. They just take you at your word. You say, I make this much and I owe that much. Based on that, the lender will say, here's your pre-qualification letter. The pre-approval letter takes that a step further. The borrower calls the lender and says, this is my debt, this is my income. And then the lender verifies it. The lender runs that piece through underwriting and crunches those numbers. They look at your credit history, they pull. So the pre-qualification is the first step. And in a crunch, that's what you and I are getting ready to learn how to do. Again, if your lender's off on Saturday and there's a home that comes on the market that your buyer really wants to see, is it worth stopping what you're doing on a Saturday, hop in your car and go show them that property? If I were you, I would ask them what their debt to income is. I would ask them some numbers so we can do a super quick pre-qualification, knowing we're going to get them to the lender first thing Monday morning for the official qualification. So pre-qualifying a buyer math, that's kind of where we're heading. I mentioned underwriting earlier. I'm not kidding you guys. Post-housing market crash, they don't leave a single stone unturned. If there is any number related to you, income, debt, they're going to find it. So best bet as a borrower, as a home buyer, is just go ahead and get all that out there, because if you don't, they will find it. It's a much more careful selection in some cases than what it was before the housing market crash. So they're looking at your credit characteristics. Again, what's your credit history, credit score. They want to look at all your assets, not just your income, but how stable is it. Y'all want to hear something ironic? Are you ready for this? Real estate agents aren't always easily approved for home loans because we don't have consistent income. I don't get paid every other week. I get paid when it closes. So I may have a month where I have 4 closings and then I don't have another closing again for 3 months. So I'm not saying, hang on, don't get excited. I never said we couldn't get a home loan, but I'm just saying we don't have that stable income. We don't get paid every 2 weeks. So real estate agents may have to have provide more of a credit history to show that they have money consistently coming in, even though it's not every 2 weeks. And then, of course, they're looking for acceptable income. You know, cash is king, but in the mortgage lending world, cash offers a lot of questions. If you show up to the lender with a big bag of cash, plop it down on the table and say, this is my down payment, they got some questions like, where did it come from? They want to make sure that it came from a legal source. Are you a drug dealer? Are you in the mafia? They want to know where the cash came from. So it's not just any income. You got to show where that income comes from. And this is the job of the underwriter, is to crunch all these numbers and verify. I tend to think of underwriting as like this big black hole somewhere, because I'll call the lender and I'll say, hey, just checking in on the loan process. And the lender will say, oh, it's in underwriting. And I think, where is it? Where do I find it? Where can I go find this magical, mystical place called underwriting? It's out there. Some lenders have their own in-house underwriters. Some source it out. Once the lender gets the first required set of documents that they need, they call the borrower and they say, okay, we need this, this, and this. And once they gather the first round of information, they send the loan to underwriting for underwriting to do the big crunch. It's not uncommon for the loan to come out of underwriting the first time requesting more information. It's not uncommon at all. So now we're in round 2, right? Tell your borrowers, the lender is still a priority. If they call you and ask you for an additional document, get it to them. If they call you and ask you for something you've already sent them, send it to them again. Again, you guys, the lenders can't go on with their process until they have what they need. So it comes out of underwriting the first time. They say, we need 3 more documents. The borrower gets them. It goes back through underwriting. And typically after the second time, we will have approval or denial of the loan. Here's the kicker. It's really uncommon to have final loan approval while we're still in due diligence. It's really uncommon. In all my years, I've only known one buyer to get final loan approval while we're in due diligence. So let's talk about what this means. We want to get through at least the first round of underwriting while we're in due diligence. What we get from the first round of underwriting from the lender is a pretty good idea of whether or not we're going to get loan approval or not. There are no guarantees yet, but the lender can offer us a pretty good idea if we're going to get loan approval or not. And if it's not looking good, the lender says, this one's going to be tough. We're still in due diligence. The buyer has a decision to make. They either risk it, go past due diligence, risk losing their earnest money, or they terminate and get their earnest money deposit back. But it's going to be, like I said, one buyer. In all my years, I've only known one buyer to get loan approval while we're in underwriting. So the sooner we can get through the first round of material to get to the first round of underwriting. Again, ideally, that's happening in due diligence. So the buyer can make a decision whether or not to move forward or terminate the transaction while we're still in due diligence to get their earnest money back. Do I have any questions about that? How long on average does it take to complete underwriting? That's a great question. I'm going to say it depends. It depends on the underwriters. It depends on the lender. It depends on the market. You know, busier markets, you got more work for everybody to do. The appraiser's busier, the home inspector's busier, right? Like everybody's busier when we're busy. But I'd say, you know, a couple days to a couple weeks, I guess, best guess. Buyer's agents, if you've never worked with this buyer's lender before, when you're writing up that offer, it may not be a bad idea to call that lender and say, how long do you need? Because that may help me determine how much due diligence time to ask for. Does that make sense? If I've never worked with this lender and I don't know how they work and what they practice, I can call them because it best protects our buyer and their due diligence. So communicate. How is the closing date determined? If you don't know how long, it's all negotiable. So again, depending on the market, we may need, you know, if it's a slow market, I don't need as much time. If the market's busier, we may need more time. So it's just one of those negotiable. And once you do a few transactions, you kind of learn, you know, once you work with a couple lenders a couple times, your preferred lenders, you learn how they work. Again, where you throw that curveball is when that buyer wants to use a lender you've never worked with before. That's okay. That's their choice. It's their lender, it's their choice. But just call that lender and say, what's our average timeline? We are trying to get our buyer into contract. Guess what, guys? The lender doesn't get paid if it doesn't close. So don't we all have a vested interest in getting this thing to closing? We want to get paid at the end of the day, right? So we're going to work together, hopefully, and communicate. Somebody said their closing date was changed 5 times. Sure, it happens. Expect delays. I always tell my guys to have a plan B, buyer and seller. My crystal ball is pretty good, but it's not that good. It's a process. They call it a loan process for a reason. And guys, honestly, the loan process is the longest part of the contract to closing process. It is the longest part. So getting that loan approval is what takes the longest, which is why it's recommended you call the lender and ask them, how much time do you need? So we can set up those dates in the offer. Does that make sense? We can know how much due diligence to ask for and when to close. It is all around the lender's schedule. So when we talk about qualifying a buyer, there's some qualifying ratios. Now, this is the math that we're getting into in just a second. So I'm not going to spend a lot of time talking about these numbers yet, because we're going to talk about them in a minute when we pick up our calculators. When we do pick up our calculators, we're going to focus on the conventional ratios of 28-36. And again, we're going to talk about what those numbers mean in just a second. FHA loan uses ratios of 31-43, and then the VA just has one ratio. It's a different approval process. So the VA just looks at the total debt to income ratio. They don't break it down into 2 different ratios as does the conventional and the FHA. Again, talking more about the conventional in just a second. So coming back to this, before we get there, let's say something else about TILA. Remember, TILA is the T in TRID. TILA is an acronym for the Truth in Lending Act. TILA is also known as Regulation Z. You need to know that TILA is also known as Regulation Z. You may see a test question about Regulation Z, and you need to know what that is. TILA and TRID are lender laws. They're not real estate agent laws. They're not borrower laws. They're lender laws. and they're meant to protect the consumer. So TILA tells the consumer the cost to obtain the loan. So TILA gives the consumer disclosures about securing a loan to purchase the home. When you see TILA, see lending. TILA is about the loan. How much is it really going to cost the consumer to get this loan? All the charges, the fees, loan origination fee, the MIP, the funding fee, depending on what type of loan we're using, is there PMI, discount points. What is the cost to get this loan? So the T in TRID is TILA. TRID is a lender law. We introduced you to the Consumer Financial Protection Bureau, again, understanding in this transaction, the consumer that we are protecting is the borrower. Why? Because they are the ones originating a new loan. The seller already has a loan. The borrower is the one getting a new loan in this transaction. So TRID cares about the buyer. And one thing that TRID requires is that the lender disclose certain information about the loan, referred to as the chief disclosures. Now we're going to break these down. I'm going to tell you what those chief disclosures are. The big thing about TRID, you guys, is to disclose. Is it going to surprise you guys? Prior to the housing market crash, there were times that buyers were seeing their numbers for the first time at settlement. What's your monthly payment going to be? I don't know. You got to wait till settlement. How long is your loan? What's the terms of your loan? Don't know. How much do I have to bring to closing? No idea. You have to wait till settlement. Does that seem like that's a good thing for the borrower? Not know those numbers, not see those numbers? I mean, guys are getting ready to make a 30-year commitment. I don't know. I haven't been in a relationship for 30 years, not alone with my lender for 30 years. You guys with me? That's a long time. Guess except my parents, but other than that, you know, that's a long time. Isn't it only fair that the consumer knows what they're signing up for? Isn't it only fair that the consumer has a chance to look at these numbers, ask questions? And that's what TRID is about. That's how they are protecting the consumer. So the lender has to provide the consumer these chief disclosures. The APR is the annual percentage rate. APR is annual percentage rate. The APR is all of the finance charges. It's the interest rate. Yes, it does include the interest rate, but it's all fees charged. The APR is a truer picture. The interest rate is just that. So the chief disclosure is the lender on something called the loan estimate that we're going to talk about. The lender provides the borrower with a loan estimate, and the loan estimate tells the consumer, this is your APR. If there's any financing charges involved with the loan, how many payments are you going to make and what's the amount? And then how much are you borrowing? The total amounts financed. So very early in the transaction, the loan estimate comes out early. And very early in the transaction, the borrower is learning about the numbers associated with their loan. Doesn't this seem more fair? We're giving them plenty of time to look at it. Again, if they have questions, if they don't understand, we're giving them time, which is not what all buyers had before. Another big thing that TILA does, guys, keep in mind, TRID is a lender law. Please write that down. TRID, T-R-I-D, is a lender law. So let me ask you guys something. If this is a cash buyer, no lenders around, is TRID involved? Do we have TRID laws if we don't have lenders? No. If it's a cash buyer, the rule is there are no rules. If it's going through a lender, we got to follow TRID. Does this make sense? TRID is a lender law. So cash buyers, No lenders. And another big thing that TILA, the T of TRID, does is it gives the lenders advertising regulations. Lenders have to be careful about how they advertise terms of the loan. We're going to look at some examples in just a second. Specifically, TILA tells lenders to look out for trigger terms. Lenders cannot advertise a specific number about the loan. They can use generics. And again, we're going to look at some examples in just 1 second. I don't know you guys all that well, but I know enough to know that we all have a different credit history. We all have a different credit score. We all have different income to debt ratios. Can we agree with that? I mean, if we really wanted to have fun this afternoon, y'all want to have a good time? Let's all, 39 of us, call the same lender and apply for a loan for the same property. Doesn't that sound like fun? I promise you, we're all going to walk away with different terms because we all have a different story. Does this make sense? So when lenders advertise loans, they need to be careful that they don't advertise a one size fits all. And if they hit specific numbers, they're saying these numbers apply to you, you, and you. And that may not be the case. So instead of a one size fits all, they have restrictions, regulations on how they advertise their terms. Again, speaking in very general and not specific numbers. So what TILA tells the lender that if there's any number about the loan that's disclosed in the advertising, then the lender is assuming a one size fits all, and they got to disclose all of the terms. So if they tell you you can get this loan for 30 years, they got to tell you how much, what your interest rate is, when it's due. Does this make sense? They got to give all of us this same term, regardless of our credit history. So trigger terms, again, specific numbers. Please note about the loan. Is the listing price about the loan? The seller says, I have a house for sale for $200,000. Is that about the loan? No. What about HOA dues? Is that about the loan? Please note, we're looking for specific numbers about the loan. Specifically, numbers about the loan include how much down payment, how much of any payment. If you get a 15-year loan, you don't have as many monthly payments as you do for a 30-year loan. The number of payments, again, how many times, repayment, period of repayment, and then the dollar amount of the finance charge. It's because of the credit history. That's exactly right. It's because of each of our credit history why we walk away with different terms and why the lender can't advertise a one size fits all. They can't say everybody that sees this advertisement is eligible for this loan at these terms. It just doesn't work that way. They got to look at each of us individually. And that's where they need to be careful about their advertising, lenders. So trigger terms, if any of these numbers are hit in the ad, the lender needs to disclose all of the terms. So let's look at a couple examples by specific numbers. Do we see a difference between $600 monthly payment versus low monthly payment? Which is a specific number about the loan? Isn't it the $600? Do we see a difference in zero down payment versus low down payment? Again, what's the specific number? If they advertise zero down payment, that means all 39 of us can apply for this loan and not bring any money to the table. Maybe you can, maybe you qualify for that. Maybe you qualify for a low down payment. Low down payment just implies a little bit of money. So trigger terms are specific numbers, not talking in general. As we said, TILA is about the loan. The asking price is not about the loan. The HOA dues are not about the loan. What's about the loan? Term, payment, interest rate, down payment. And then with TILA, once the lender hits a trigger term in their advertising, then they have to disclose all of the terms. Again, they're applying, if they say 0 down payment, they're saying every single one of us can get this mortgage loan with bringing how much to the table? $0. So when a trigger term is hit, then all the information about the loan. So how does a lender avoid this? They don't hit specific numbers. They don't hit trigger terms. They talk in general. Low down payment, low financing. Do all lenders follow trigger terms? All I can speak of is mortgage lenders. TRID is about the mortgage loan. Remember, we're just in the mortgage piece of it. I can't tell you about a car loan or, anything like that. So, gee, Julie, what's the big deal? Well, lenders that violate TILA could be looking at fines of $10,000 per day. $10,000 per day. They could be looking at other fines. They could be looking at prison time. What's the big deal for lenders if they advertise these trigger terms? They could get themselves in kind of a heap of trouble financially and in jail. So a better question is, Julie, if this is a lender law, why do we care? Is that what you're wondering right now? Why the heck do I really care? Well, let me tell you why you care. Let's say you have a license and you have a new listing, and it's a nice new listing. It's very nice. And you decide you want to do a broker open next week to introduce your new listing to all the area real estate agents. So you're going to provide lunch and you're going to have lemonade and you're going to invite agents in from 11 to 2 to come ooh and ah over your new listing. Broker open. Hopefully they have buyers that once they see it, they'll bring their buyers. When you're preparing for your broker open, you call your lender buddy and you say, I'm doing a broker open. You want to go in on it with me? You want to split the cost of lunch? Your lender buddy's probably going to say yes, because what a great way for your lender buddy to meet other agents. Everybody with me so far? So you and your lender buddy are going in together on this broker open. And your lender buddy says, let me do the promotional flyer. They put your name, your phone number, your email address with your picture on the flyer, and then they hit a trigger term. Have you advertised specifics of the loans? Even though you didn't actually put the flyer out, isn't your picture on there? Could you be held liable for advertising those trigger terms hidden? Yeah, because you're on the advertising. So why do we care? Because we need to know when you tell your lender buddy, gee, that's nice, but let me preview the flyer before you send it out. Everybody with me? Make sure that these trigger terms aren't hit. Real estate agents, if we are on an ad with a trigger term, we can face the same penalties, $10,000 per day, prison time, and guess what? You're going to face disciplinary action by the North Carolina Real Estate Commission too. Let's throw that on top of everything else. So because of how closely we work with lenders, sometimes we may want to make a listing more sellable by talking about the terms of the loan. Maybe you had a conversation with a lender and you think you know everything and you want to put that in your ad. You need to be careful that you're not hitting those loan trigger terms. Questions on TILA? Before we take a break, I had a question come in after last break about the midterm. We are not going to talk about the midterm in class. That's behind us. We're moving on. So you guys should have gotten a report from the midterm? Did you get an email report and it tells you the different areas? So it says like, and then you saw a number in parentheses and that tells you like, that's the unit number. So you know how well you did in unit 2, unit 3, unit 4, unit 5, unit 6, etc. You can use that report to help you identify your areas of weakness to help prepare you for the end of class exam. If you have specific questions about the midterm, you just need to reach out to me. So use that report. If for some reason you didn't get the report, just reach out to me. I'll get it to you. But we definitely want you to see that report so you know how to spend your study time going forward. Okay. Let's take a break. We come back, we keep trucking along in unit 15. We're back. I am taking attendance. I see cameras coming on. Welcome back. I am taking attendance. Questions about TRID or TILA? Thank you for telling me that you're back. I have taken attendance, so make sure you tell me. Thank you. A couple other lender laws we need to just be aware of. Again, getting that basic understanding, that general knowledge. There's something out there called the Federal Equal Credit Opportunity Act. This says that there's a certain protected classes that the lender cannot discriminate against. In other words, the denial for a loan cannot be on the basis of the applicant's race, color, religion, national origin, sex, marital status, age, or dependency on public assistance. When we get to Unit 19, we're going to talk about federal fair housing, which is the broker's protected classes. So we're going to do a nice side-by-side comparison about the lender's protected classes versus our protected classes. And we're going to see a lot of similarities, but there are a few differences. So once I introduce you to our protected classes, we'll see this again and do a nice side-by-side comparison. By the way, for the lender's protected classes, you guys see age? That is assuming that the applicant is 18 years old. You cannot have a minor. Thank you for telling me you're back. You cannot have a minor apply for a home loan. So who's protected in age? If a 90-year-old walks into the bank and applies for a 30-year loan, I'll let you guys do that math. They cannot be denied because of their age. If they're denied, it better be because their debt to income ratio doesn't work out. Does that make sense? That's who we're protecting with age, is more the elderly. The Equal Credit Opportunity Act also tells the lender that if they're not going to give you loan approval, they have 30 days to tell you why. So they have to send you something in writing saying specifically, this is why you're not getting that approval. Again, it better come down to debt to income ratio and not have anything to do with the applicant's race, color, religion, national origin, sex, marital status, age, or dependency on public assistance. So Federal Equal Credit Opportunity Act, we'll see this again. We can remember this is the lender law. You guys see the word credit? We're dealing with lenders when we're talking about credits, credit for the loan. Another lender law is the Fair Credit Reporting Act. This is what gives you and I the right to check our credit score every year. And if we see issues on our credit score, then we have the right to get those corrected. You guys are familiar with the three sources, Equifax, Experian, and TransUnion, the three places that our credit scores come from. And the Fair Credit Reporting Act says that we have the right to verify that information. And if we see something wrong, we can work to correct that. Credit reports go back 7 years. So they're going to track your last 7 years of debit, debt, and income. Bankruptcies stay with you a little bit longer. So if you or your buyer was a bankruptcy, their credit information is going to go back 10. Another thing that lenders have to look out for is loan fraud. Loan fraud's bad. Loan fraud's really, really bad. Loan fraud is lying on a loan application, trying to get yourself some more money. You want more money, so maybe you embellish your income, or you don't report all of your debits or the amount of your debits. Lying on an application. If the lender determines you've committed loan fraud, you may face punishments. That's not a typo, you guys. That's a fine up to $1 million and or 30 years in prison. See, I'm not kidding when I said loan fraud is bad. It's like really, really bad. There's something called the North Carolina Predatory Lending Act. This is consumer protection. This is what all this is about, is consumer protection. It's helping to keep the lenders in track online to offer the best protection for the consumers. So they have restrictions on high cost loans. They have that ceiling. If there's any fees or charges charged to the borrower, the Predatory Lending Act, not related to their loan, I should say, the Predatory Lending Act can require the lender to revise those charges, allow them to credit them at closing, for example. This also allows them to change their terms, the fees and the charges. Again, it's up to each lender. They just have limitations on how high they can go. Unfair, deceptive lender practices, and then consumer education. I think consumer education is one of the most important things that lenders can do for consumers, is help educate them about their loan. Again, you guys, you're getting ready in some cases to make a 30-year commitment. Don't you want to know what that 30-year commitment is? Don't you want to know what that's about? And that's where all of our lender laws are focused on today, is that consumer protection. And one of the best ways we can protect consumers is lender laws. We briefly mentioned TILA of TRID. The R in TRID is RESPA, Real Estate Settlement Procedures Act. We're going to talk more about this in Unit 21, so I'm just introducing it to you here now. TILA tells the consumer the cost to obtain the loan. How much in fees are you going to charge me to get this loan? RESPA tells the consumer the cost to close. When you guys see RESPA, see the word settlement. What's it going to cost you to go to settlement? What's it going to cost you to go to closing? Remember, we said TILA is also known as Regulation Z. We're going to learn in Unit 21 that RESPA is known as Regulation X. I introduced that to you now so you can do a side-by-side comparison. TILA is Regulation Z. RESPA is Regulation X. We will talk a little bit more about RESPA when we get to Unit 21. Questions? Okay. So the rest of 15 is a little bit of math. The first piece of math that we have is dealing with your monthly debt service, your monthly principal and interest. You remember last week we amortized the loan monthly. We did our 3 steps and we figured out this month's monthly interest and this month's monthly principal, and then we figured out what next month's balance would be. And the problem we worked last week, it gave you your monthly principal and interest, your monthly debt service. And it stayed the same the life of the loan, right? That amount did not change. Last week, we were actually given that amount. And the question came up, will we always be given the monthly payment? Will we always be given the monthly principal and interest? And the answer is no, we won't. So we need to find out how to solve that monthly principal and interest so we can find that to amortize. Let's see, according to RESPA, the cost of the loan should be fixed. Absolutely not. RESPA is about the cost to close. How much is it costing the consumer to close? What are your closing costs? So before we look at the formula for the monthly principal and interest, let's turn in our books to pages 412 and 413. 412 and 413. And what we have on 412 and 413 is a mortgage factor chart, also known as a rate factor chart. Could be used interchangeably. Now, the number one question I get is, do we have to memorize this chart? No, no, you don't. Is that good news? However, you need to know how to work it. Because for your exam, for your state exam, they may not give you the rate factor. I have had students tell me at PSI Testing Center, there's this chart really big on the wall in which you got to find the rate factor. So understanding this chart could be a step towards getting the problem right. So the first column you have in the chart is the rate. That's your interest rate. Please write that, interest rate. And then all columns after that, you have the term of the loan. So is it a 10-year loan, a 15-year loan, 20-year loan, 25 or 30? For the lender to find your rate factor, they're going to go down, look at the interest rate on the left, and then go over to the term to find the rate factor. So let's say, for example, you guys set your private chat. I want a private chat from everybody, please. Tell me in a private chat, what is your rate factor if you have a 5% interest rate for 30 years? 5% interest rate for 30 years. And you're telling me in a private chat, what's your mortgage factor? 5% interest rate for 30 years. You see it? So 5% interest rate. Take your finger, see the rate, and go down until you see 5%, and then go over to the right until you're under the 30-year term. And your rate, what you're finding, what most of you are telling me is 5.37. Everybody see that? So if you're asked this problem on your exam, they're either going to give you the rate factor or they have to provide you with the chart so you can find it. You don't have to memorize this. I must always get asked that. And I'm at the point now where if you ask me, I'm just going to tell you yes. So hear me now when I say you don't have to memorize this chart, but you need to know how to work it. And that's how you work it. They give you the interest rate, they give you the term, and you find the rate factor. Do I have everybody so far? So now that we have the factor, I got a formula. And unfortunately, I cannot do a T-bar, which means we just need to memorize the formula. All formulas go on flashcards, or on day one, I recommended a piece of paper with the word formula across the top. Knowing the formula is 80% of the battle. So how do you solve for your monthly debt service? If the problem doesn't give you that monthly payment, that monthly principal and interest, you take the loan amount times the rate factor and you divide it by 1,000. It'll give you the loan amount. It'll either give you the rate factor or the information you need to find it. It's not going to give you the 1,000. This is where knowing the formula is going to get you through this test question. So the loan amount times the rate factor divided by 1,000. Everybody have this in front of them? Y'all know what's coming next? You get to do one. Everybody have the formula? Can't do it without the formula. Tell me in a private chat about the Millers. We got 30 more seconds, and we'll work it together. So what do we do first when we see a math problem, or any problem for that matter? What do we do first? Just read. It amazes me how we talk about this for months and months, and then you go show up on test day and just pick your calculator up and start. Just read. Just read. The Millers are borrowing $350,000 at 4.5% annual interest for 30 years. Using the mortgage factor chart is determine the mortgage factor is 5.07. What will the Millers' monthly debt service be for the loan? So we remember from the previous slide, we're looking for debt service, which is the monthly principal and interest, your monthly payment. And we're going to take the loan amount times the interest rate. And then we're going to divide that by 1,000. There's our formula. If you don't know the formula, you don't know how to do the problem. Because if you don't know the formula, aren't you trying to do something with the 4.5%, the 30 years? Those are called distractors, you guys. What's a distractor's job? What's its whole purpose of existing? To distract you. So how do you win? How do you rule out on distractors? You know the formula. So our formula tells us to find our monthly debt service, our monthly principal and interest. We take the loan amount times the rate factor. This time it gave it to you. If it doesn't, you have the information you need to look it up. Interest rate, loan amount times the rate factor divided by 1,000. Now, if we take our loan amount times our rate factor divided by 1,000, I get a monthly principal and interest, a monthly payment your monthly debt service for the life of this loan is going to be $1,774.50. How did the lender determine that? Because they used the rate factor chart or the mortgage factor chart. That's where that comes into play. That's what that number means. It helps the lender determine how much to charge you each month based on your interest rate, your locked-in rate, and the term of the loan. Hold your place in the book for 1 second and go back to page 387 with me. 387. On page 387, numbers 28, 29, and 30, they kind of build off each other. So you can't answer 29 until you do 28. You can't do 30 until you do 29. Last week, I told you guys not to worry about this because you don't have the information you need to do number 28. Now you do. First thing you need to do is find that monthly principal and interest, your monthly debt service. So now you can go back. There's some extra practice there for you. Questions on this? Loan amount times the interest rate divided by 1,000. The second piece of Unit 15 math is not in your book. It was, they took it off the exam, so they removed it from the book. But then guess what they did? They added it back to the exams. I got practice for you guys. Trust me, never worry about that. We're just waiting for it to come back to the book. I'm in a good mood, so everybody, listen to me. This next math you're getting ready to do, you're not going to see on my end of class exam. This next math we're getting ready to do, you may see on your state exam. My suggestion is to let us go through it, knowing that we're recording. Make a note right now in your notebook See the end of Unit 15 recording when you're getting ready for your state exam. Is everybody hearing? There's your gift for the day. You're welcome, by the way. So we're going to go through this. So you guys have the recording. You can come back through when you're focusing for your state exam. But I don't want you to hurt yourselves getting ready for my exam. Is that fair? Oh dear. Breathe. So the math that you may see on your state exam, you may see it. I don't know if you will or not, but you may. It's called qualifying a buyer math. And this is where we're going to focus on specifically the conventional loan ratios. Two ratios of 28% and 36%. These two ratios do two different things. So let's talk about what these ratios mean. The first ratio we're going to talk about is your 28%. And when we're talking about qualifying a buyer, I want you to think about pie. Let's say that this pie represents the borrower's monthly income. Monthly income, all the money that this borrower has coming in this month. The whole pie represents their monthly income. And what this first ratio says, of their entire monthly income, the lender will allow 28% for housing expenses. So of all of your monthly income, the lender will allow 28% or less of your housing expenses. Your housing expenses consist of your principal and interest, taxes and insurance, HOA dues if applicable, and PMI, private mortgage insurance if applicable, conventional loan, 80% loan to value ratio or higher. So the first qualifying ratio, the 28%, looks at the borrower's housing expenses. 28% of your housing expenses, 28% of your income can be allotted towards housing expenses. The second ratio is the 36%. And again, if we think about pie, and the whole pie represents the borrower's monthly income. Hear me when I say monthly income. And what this ratio says is of your entire monthly income, 36% can go towards housing expenses plus your reoccurring debt. Housing expenses, we just said, are your PITI, HOA dues, and PMI if applicable. The 36 looks at housing expenses plus your reoccurring debt, car payments, student loans, alimony, child support, medical bills. What are those bills that you sit down and write or pay every single month? That's your reoccurring debt. It's reoccurring because you pay it every month. And what the second ratio says is that of the borrower's entire monthly income, the lender will allow 36% to go towards housing expenses and reoccurring debt. In order for a borrower to qualify, they have to qualify under both ratios. Both ratios, the 28% or less and the 36% or less. And I'll tell you guys right now, what hurts most Americans is our dang outstanding debt. When you go to apply for a loan, you call a mortgage lender today and say, I want to buy a house, give me money. Do you not think they care about money that you're already committed, money that you already owe other people, like student loans, car loans, alimony, child support? Doesn't that affect how much you can pay towards the loan? So they have to look at these pre-existing debts. If the buyer doesn't qualify for either one, a good lender is going to work with this borrower to get their ratios below the 28 and the 36. So obviously the obvious solution is make more money and pay off your debt. Just like that, huh? Make more money, pay off your debt. Is that easy? If that doesn't work out, then the other thing we might consider is looking for a less expensive home. Maybe we're looking above the borrower's price range. If we have a less expensive home, the PITI will be less, the housing expenses will be less. Does this make sense? So a good lender is going to look at these 2836, say you're over one or both. What can we do to help get you under? And it might take time. It might take a while for them to pay off some of that debt so they can get under the 36%. And that's why I say a good lender. Because if a good lender is working with a borrower, once they do get their ratios under, who does the lender want that borrower to call when they are ready to buy? And they're going to remember the one that helped them get here, right? Guess what? If you, the real estate agent, have already talked to this buyer, work with that buyer, stay in touch with that buyer over the next couple of years, however long it takes them to get themselves ready to buy. Because if you stay in touch with them, if you send them a holiday card and you call them every once in a while and ask them how little Susie's doing in school, when they are ready to buy, who are they going to be apt to call? They're going to call you to be their agent, aren't they? We got to stay in front of them sometimes. Sometimes we have to incubate buyers, you guys. Not everybody that wants to buy a house today is ready. So if we incubate them, if we keep in touch with them, they're going to call you. And that's what we want. So two ratios must qualify under both in order to qualify for the loan. The example we gave earlier, when your lender's off on the weekend and your buyer wants to see this home, this is the quick math we can do to see if it's worth showing it to them. I'm not giving them a pre-approval. I'm not a lender, but I can do a super quick calculation to see if it's worth my time on a Saturday afternoon to go show them property. Does this make sense? So we talked about the ratios of 28 to 36. Now let's look at our formula. And guess what? We can use a T-bar. Qualifying a buyer numbers work in monthly. We're looking at their monthly expenses as part of their monthly income. Can you ask me that on break, please? What that gives us is our qualifying ratio. That qualifying ratio needs to be under either 28% or 36%. When we do qualifying a buyer math, we use this same T-bar twice. One for the 28% and one for the 36%. So we're going to use this T-bar, we're going to use it twice. Now, again, you guys made a note. We're going to go through this. I'm not giving you guys any practice to work in class. I have plenty of practice for you guys outside of class. I feel like our time could be spent better. Step one, helping you get ready for your end of class exam, knowing you have the recording to go back to prepare for your state exam. Is everybody with me? You can go back through when you're getting ready for your state exam at your own pace. And like I said, I do have practice. I'll show that to you in just a second. So we're going to go through these together. And we're going to do a sample problem to find this borrower's monthly expenses. We're going to do one to find their monthly income, and we're going to do one to find their qualifying ratio. So we're going to see how each of these are handled. Understanding any of them could be a good candidate for your exam. So for some reason, I always forget to give myself my whiteboard. I don't know why, but I do. Let me get my space to write here. Everybody have a T-bar jotted down? Are you guys here? Are we here? Okay. So monthly expenses is part of your monthly income, and the rate qualifying ratio. So first problem. Jerry and Shannon are considering purchasing a home. Together they earn $83,000 per year. Their estimated housing expenses are $1,500 per month. Their monthly recurring debt is $1,100. Would Jerry and Shannon qualify for a conventional loan using the 28-36% ratio? I've read the problem. I know I'm doing qualifying a buyer math. So the first thing I'm going to do is throw down two crooked T-bars. One for the 28%, one for the housing expenses, and then another one for the 36%. In this case, what we are solving for are Jerry and Shannon's qualifying. We're looking for their qualifying ratios to make sure that they are both under the 28 and 36. So my X in both is our ratio. I need them to be under the 28 and the 36. So now we fill in the rest of the T-bar. Their annual income is $83,000. Does your formula want annual income? It wants monthly. How do you convert annual to monthly? Divide by 12. So their monthly income is $6,916.67. So the first thing we did, based on the information in the problem, is we solved for their monthly income. We took their annual income and divided by 12. Qualifying a buyer math is always in monthly. When the problem gives you annual, divide it by 12 to get monthly. Everybody good so far? Now we need to look at their monthly expenses. The first ratio looks at their housing expenses only. This is their PITI, their PMI if applicable, and their HOA dues if applicable. So the first ratio looks at their housing expenses. The back fourth line on the T-bar means divide. So you take their monthly expenses divided by their monthly income. And I get on my calculator 2168833, so on and so on. When I move my decimal over two places, I have a 21.7, we'll say, percent ratio. How do you go from a rate to a percentage? Just move your decimal over two places. So your calculator gives you the rate of 0.29. Did I do that wrong? 67. Okay. So your calculator gives you the rate, 0.216883. That shakes out to 21.7%. Under the housing expenses, do Jerry and Shannon qualify? Are they under 28%? So far, so good, right? So far, so good. In order for them to qualify, they have to qualify under both. So before you answer this question, yeah, they qualify, we got to look at the second ratio. The second ratio looks at our housing expenses plus our reoccurring debt. The second ratio tells us that their monthly expenses are $2,600. Is that right? That fourth line on the T-bar means divide. So 2,600 divided by 6916.67. And I get a rate of 0.3759034, which shakes out to 37.6%. 36.7%. Did Jerry and Shannon qualify under the second ratio? Game over, folks. Jerry and Shannon aren't going to get this loan with these terms because in order to qualify, both of their debt to income ratios have to be under the 28 and 36. They're close. And this is where a good lender is going to have a conversation with them. Jerry, Shannon, you need to get some of your debt paid off. You need to make more money, or we need to find you a less expensive home. If we can lower those numbers, they're close. But they just don't qualify with these terms. So the first round, the first set of problems is to solve for the qualifying ratio. Questions on this one? Okay. How do we get to 2,600? We added their housing expenses plus their reoccurring debt. The second ratio looks at housing expenses plus reoccurring debt. Why would your state exam have you pre-qualifying? You may see this test question on the national section of your state exam. By the way, there is no math on the state section. All math is on the national section. So that's probably why they just gave us. They're trying to keep it easy for us and just let us work with conventional. First one looks at just housing expenses. Second one looks at housing expenses plus reoccurring debt. Don't go anywhere. Everybody hang tight for a second. We're getting ready to take a break, but I do have, we're getting there. Give me a second. we are going to work more after break, as promised. I also show you guys where I have practice. But before we go on break, I do have a couple announcements. So don't go on break just yet. Everybody stay with me. One, let's see, I got a question earlier about the YouTube video in our YouTube channel. I load it as fast as I can. So Zoom has to process it. And then when Zoom's done, then I have to upload it to YouTube. So however long it takes Zoom and however long it takes YouTube to upload is usually about how long I can get the video in. I usually say by the time you guys are sitting down to eat dinner tonight, the video should be there, assuming we don't have glitches in the internet. The other couple things I just want to, couple reminders, couple announcements. Well, that didn't load. If we could see our tentative schedule, there it is. Just a reminder, you guys have a cram course on May 20th. Please make note of that day. May 20th, it's a Saturday. We will give more information closer to time. Lane will send you guys Jane's Zoom link the day before. We're not going to send it sooner because then that's time for you to lose it. So no, the cram course is optional. It does not count for or against your time. You're here because you're there because you want to be. If you don't want to go, don't go. But it's a cram course. It sometimes helps to hear the same material from somebody else. So I do recommend, and if you can't make the whole time, then just come when you can, as much as you can. Again, it's online, it's on Zoom. It's optional. So May 20th. And then other date reminders, May 23rd, the last day of class together is our end of class exam. We will talk about that again as we get closer. I don't want to talk about it now and then have to talk about it again later. So we'll get into specifics. I am going to say this now though, and this is where I need everybody to listen to me. I asked you guys on day one to be taking this class in a distraction-free environment. Some of you are, some of you aren't. When it comes to the test day on May 23rd, I tolerate 0 distractions. So if you are not in a distraction-free area right now, I need you to start securing one. If anybody else is in the room with you during the test, if anybody else is talking to you during the test, I can only assume that you're talking about the test. So tell your family and friends to leave you alone that day. Tell them to give you your space. And this is why I'm sharing this with you now. So you guys can start securing that distraction-free zone. I tolerate 0 distractions during the end of class exam. Is that clear? The other thing, your retake, same rules for your retake, is that Thursday on the 25th. Again, we'll send out specifics. We'll talk more about that. Usually the last thing I do on the 18th is the rules and expectations for the end of class exams. What applies for the first exam applies for the retake. So we'll go over that. Again, I just want you to start securing a distraction-free zone now. If you have any questions, just reach out to me outside of class. I'm happy to help. We're going to talk about it. We'll talk all about it. The other thing I want to share with you guys, YouTube channel. Oh, I leave up for a year or so. Yeah. If you're 3 years from now or 2.5 years from now and you want to go take your state exam, you may want to reach out to me for a current YouTube channel link. You're always tested on the current. So if you wait 1.5 years, what we're talking about today may not apply. I'm here to help even after the class ends. I just had a girl reach out to me the other day. She took my class. She finished it in September of 2020. And she said, Julie, life happened. I wasn't able to take my state exam. Now what I'm going to do, what can you help me with? I sent her YouTube channel. I said, honey, if you haven't touched this stuff in 2.5 years, you got to start over. So got her that current information. The other thing I want to share with you guys real quick, I know a couple of you are looking for additional study material. We've talked about not going out there and just spending a bunch of money, right? If you've been through the online learning system and you've been through the textbook and you're looking for other stuff to study, I do have a couple recommendations. First off, the author of your book is Dearborn. Look at the front cover. And on the front cover, the bottom right, it says Dearborn. Everybody see that? Dearborn has an app. And the app has additional test questions. They're similar to the online learning system where you answer it and it tells you why it's right or wrong. You may want to look into the app. There is a cost. I can't tell you offhand how much it is, but you may want to look into the Dearborn app if you're looking for additional study material. Another resource I'd like to recommend, when you guys got your book from Lane in the mail or when you went to pick it up, you got a whole bunch of other stuff with it too. And one of the things you got was a little flyer for Exam Smart. Can you guys see this? Somewhere in your materials from Lane is a flyer for Exam Smart. Again, there's a cost. I don't know how much it is, but there's a cost. But they offer additional practice questions, videos, flashcards, etc. So if you're looking for additional information, and guys, you've been through online learning system in the book. Why are you spending money if you haven't used the resources that have already been given to you? So this is for those of you that have been through the book, been through the online learning system, and you're looking for something else. I recommend either checking out the Dearborn app or the Exam Smart. If you don't have this flyer, if you need this flyer, just shoot me a message after class and I'll send you a picture of it so you know where to go. But it's Exam Smart. You can Google it. Hear me when I say spending money on a bunch of products isn't what's going to help you pass. What's going to help you pass is using these products. I know sometimes students like to buy everything they can get their hands on, but it doesn't do you any good if you don't use it. Does that make sense? Save your wallet a little bit. Look, I already got a testimonial to Exam Smart. Thank you, Erica. So just some things for you guys to think about. Let's see, today's May 2nd, your exam's on the 23rd. So we have 21 days. And then you guys are taking a test. So as we get closer and closer, just want to give you guys some additional tools. Okay, let's take a break. When we come back, we're going to get back to our qualifying to buyer math. We're going to look at finding monthly expenses, and we're going to look at finding monthly income. So here's 10. Thank you. Welcome back. We're in the throes, qualifying a buyer math. Y'all have a note to look at this before your state exam? You have that note? Okay. So I am taking attendance. And we looked at the qualifying ratios. So now we need to talk about the monthly expenses. And before we put this all into T-bar, there's a couple things. I think this is one of these things, if you can bear with me, I'm going to show you this again. So you don't necessarily need to worry about writing this down word for word right now. I prefer you to listen for now. We will see this again, but I think this is one of these conversations that if you can bear with me, when we actually do it, it's going to make sense as opposed to what you're looking at on the screen right now. I have taken attendance, so please make sure you tell me that you're back. And once I take attendance, cameras stay on you. Don't take attendance and immediately shoot it up to your ceiling. I don't make the rules. So now we need to talk about the maximum payment. And this is the number on top, the monthly expenses. And there's a couple different things that we're going to look at with that number on top. When we refer to maximum payment, we're talking about your housing expenses, PITI, PMI if applicable, HOA dues if applicable. And we're going to put this in T-bar in a second. But all we're going to do for the 28%, the housing expenses, we're going to take our income times 28%. When it comes to the 36% ratio, remember the 36% includes our housing expenses and our reoccurring debt. So in order to do a true side-by-side comparison of housing expenses, for the second ratio, we're going to take income times 36%. And then we're going to deduct the reoccurring expenses. Deducting the reoccurring expenses allows us to just focus both on this borrower's housing expenses. So we're going to do these two different things with two different T-bars. And we're going to have two different numbers. And when it comes to qualifying a buyer, I always think of opposite world. What do I mean by that? If the problem is asking you for the maximum housing payment, then we're going to use the lower of the two numbers. When they ask you for the max, opposite world says we're going to use the lower of the two numbers. So to help us determine which qualifying ratio these buyers are going to qualify under, we're going to use the lower of the two numbers. Remember, this is payment. These are expenses. Put yourself in the shoes of the lender. Is it more risky the more expenses you have or the less expenses you have? Doesn't the lender want to see the less expensive, the less expenses? So they're looking for the lower. When we ask for maximum payment, they're looking for the lower of the two numbers. So if we look at a problem together, we can use the T-bar. So this one, Brian has an annual income of $35,000. His wife, Margaret, has an annual income of $38,000. Reoccurring obligations are $700 per month. What is the maximum payment they can afford using our 28-36% ratios? Anytime you see qualifying a buyer math, if you don't know what else to do, nothing else, throw yourself down two T-bars. Throw yourself down two T-bars. And now what we're solving for is the number on top, monthly expenses, basing it off of the 28% and the 36%. They give you the ratios when they don't ask you to solve for them like we just did with Jerry and Shannon. They give you the ratios. So what we're solving for is our monthly expenses. All of our expenses ultimately defined our monthly housing expenses, the maximum payment for the housing monthly expenses. The bottom left is monthly income. So I have Brian's annual income of $35,000. I have Margaret's annual income, which gives me a combined annual income for both of them of $73,000. We don't want annual though, do we? What does our formula call for? Our formula wants monthly. So now that we have found both borrowers' annual income, we divide by 12. And I get monthly income of $6,833.33. Questions on how I got the monthly income? So let's look at the 28% ratio first. The 28% is just housing expenses. And when the lender is determined maximum payment, that's their payment, right? That's their housing expenses, their principal and interest, taxes and insurance, HOA, and PMI. So when we talk about maximum payment, we're looking for just housing expenses. So the first T-bar, that fourth line, I'm sorry, up, down line means multiply. So we take our monthly income times our 28% ratio. And I get housing expenses of $1,703.33. 0.33. What am I doing? 6,833. Oh. I got an extra 3 here, don't I? That's where I went wrong. 8,3. There we go. That 3 doesn't exist. So 6,000. Sorry about that. 6,083.33. There we go. Yes. Times 28%. Okay. So 608. I got too many 3s in this. Times 28%. Okay. That looks better. So the first ratio, the 28%, we have housing expenses of $1,703.33. Housing expenses, let's rattle this off together. Housing expenses consist of what? PITI, HOA dues, and PMI. Those are your housing expenses, and that's what the 28% ratio looks at. The second one looks at housing expenses plus reoccurring debt. And the lender wants to do a true side-by-side comparison of just housing expenses. So for the second one, when I take our monthly income times 36%, I have, I'm just going to round here, no change. This is my housing expenses plus reoccurring debt. 36% ratio looks at both housing expenses plus reoccurring debt. So to do a true side-by-side comparison on housing expenses, now that we have this number, now we need to deduct that reoccurring debt. So now I have just housing expenses under the 36% ratio of $1,490. So housing expenses under the 28 are $1,703.33. Housing expenses under the 36, just housing expenses, are $1,490. Opposite world says that the lender is going to approve the loan on the lower of the two expenses. Put yourself in the lender's shoes. If you were giving me money, would you feel more comfortable if my expenses were $1,490 or $1,703? Which would make you as the lender feel more comfortable? The less debt I have, the more likely you are to get your money back. So when the problem asks you for maximum payment, we're looking for the lower of the two numbers. Maximum payment is looking for the lower of the two numbers. Just looking at housing expenses under the 28 and housing expenses under the 36. So we have solved the qualifying ratio. We've solved for the monthly expenses. Yes, ma'am. I see a hand.
Can you do me can you do me a favor and just the screen you had before where you had it written out, like where you had that?
Mhm.
Can you just put that up for one moment so I can just make sure I wrote one thing, because I think I understand it better looking at it that way than with the way you just did it.
I will in a minute.
No, that's
I'm gonna show
fine.
it to you again in just a second.
That's fine. Thank you.
Uh-huh. Okay. Anything else? We've done qualifying ratios. We've done monthly expenses, maximum payment. So the other thing you may see on your test is minimum income. Again, we're going to show you this again. Minimum income, again, is looking at both ratios. There's our 28, 36%. And now what we're looking for minimum income is our housing expenses divided by 28%. And for the second ratio, we're looking at our housing expenses plus our reoccurring debt. Opposite world says when the problem asks you for minimum income, we want to use the higher of the two numbers. Again, put yourself in the lender's shoes. Are you less risky or more risky to the lender the more money you make? Isn't the more you make, the less risky you are? So when they're looking for minimum income, what they're saying here is in order for you to qualify for this loan, you have to have a minimum income of X amount. And the one that you will get approved on is going to be the higher of the two numbers. So we're going to do this problem. And then when we're done, I got a side by side, maximum payment, minimum income. So we'll be able to see both of them side by side in play. So let's talk about, excuse me, Hannah and Charles. Charles and Hannah want to buy a home with a PITI of $1,900 per month. PMI will be $60 per month. HOA dues are $600 per year. Reoccurring debt is $1,100 per month. What is the minimum monthly income needed in order for them to qualify using the 28-36% ratios? If I don't know how to do anything else with these problems, throw yourself down a couple T-bars and just start plugging in what you know. The problem gives us the ratios, yes? One of these is going to use the 28% ratio. The other of these is going to use the 36%. By the way, I get asked a lot if they'll give you the 28-36% on the test. I don't know the answer to that. So I suggest you know these just in case. Part of your formula. So conventional loans, 28-36. I do know they're just going to focus on the conventional in this case, we're solving for their monthly income, which we know our formula. Our monthly income is that number on the bottom left. Let's focus on just the 28% first. The 28% is our housing expenses only. Let's do it. What are our housing expenses consist of? PITI, PMI, and HOA. Everybody with me? The first ratio just looks at housing expenses, PITI, PMI, and HOA. So we have a projected PITI of $1,900 per month. I have PMI of $60 per month, and then they throw you a curveball, don't they? We have HOA dues of $600 per year. So we need to take that annual HOA dues and divide it by 12 to get our HOA, our monthly HOA of $50. So add them up, and we get monthly housing expenses. PTI, PMI, and HOA. Of $2,010. The back fourth line on the T-bar means divide. So 2010 divided by 28% means in order for you to qualify with this income, housing expenses, your monthly income has to be at least $7,178.57. We looked at your housing expenses as they relate to the 28%. So in order for you to qualify for this amount of housing expenses, we need your income to at least be $7,178.57. If you're not bringing this in a month, you're not going to get this loan. Everybody with me? So we're looking for the income. The second number looks at housing expenses, which we've already determined, PITI, PMI, and HOA, plus their reoccurring debt. So now we have reoccurring obligations. I took my monthly housing expenses and we added our monthly reoccurring debt. So we have reoccurring obligations of $3,110. Back fourth line means divide. So under this ratio, I have monthly expenses of $8,638.89. The problem's asking me for minimum income. Through the eyes of the lender, which income is less risky? It's the one that makes more. So when they ask you for minimum income, we're looking for the higher of the two numbers. The more money you make and the less debt you have, the less risky you are to the lender. So under these borrowers will qualify, which what I'm telling you guys is, in order for them to qualify for this loan, the two of them together need to make $8,638.89 a month. They want the higher of the two numbers. Questions? Yep. 8638.89 times 12. I'll tell you what their annual income needs to be. But remember, when we do qualifying a buyer math, We talk in numbers of monthly. We don't want annual numbers. If we see an annual number, your little red flag should go up. If you don't need to do nothing else, take that annual number and divide it by 12. Because we're never going to work in annual numbers with qualifying a buyer. So we've solved for all three. And I guess any three could be a candidate for your exam. So again, you guys aren't going to see this on my test. But you do need to make yourself a note before you go to the state exam. Review the recording on May 2nd at the end of Unit 15. You can go through it at your own pace. What I mean by that is you can pause me. You can rewind me. And of course, I got practice for you guys. I'll show you in just a second. Questions? So as promised, you guys may want to take a quick picture of this, but here's both of them for you. Finding that maximum payment, the steps to actually do that, and the steps to finding the minimum income. And which number we're looking for, I always think of opposite world. If they want the maximum payment, we want the lower of the two numbers. If they want the minimum income, we want the higher of the two numbers. Somebody's asking about the cost of the home. That may be what we're not going to focus on that, because what we're trying to do is get them loan approval. So, you know, a lot of this could depend how much down payment do they have, right? The cost of the home isn't important. What we're trying to find out is, can they qualify for a loan? Some of you may have more money to put down than others, which means you wouldn't need as much loan, right? If you can put down 40% and I can only put down 10, so it's up to each individual person. What we're just focusing on is the borrower's monthly expenses as part of their monthly income. This is all qualifying a buyer is. Part of their monthly expenses, or their monthly expenses is part of their monthly income. And with that, that gets us through our financing unit, units 14 and 15. So 15, you got those key terms. Guys, speaking lender is a whole new language than speaking broker. So knowing those key terms, key point reviews on page 414, student quizzes on page 417. The math you're going to see in unit 15 is the finding the monthly debt service, the loan amount times the rate factor divided by 1,000. Again, you're not going to find qualifying a buyer in your book anymore. So that's where I'm getting ready to show you in just one second where you can find that practice. So 417 is your student quiz. The math concepts on 411, that does include our mortgage factor chart that we looked at. And then those 50 problems in the back of the book, these are the ones that relate to the numbers. These numbers are the ones that relate to what we just did. Again, with finding your monthly debt service. In addition to what you see on pages 803, your math concepts, that monthly debit or monthly debt payment, qualifying a buyer math practice. If we look in the online learning system, you guys there? Am I jumpy on your end? No? Okay, I'm jumpy on my end. And now I'm going to froze up here. In the online learning system, maybe I'll show you, under the unit 15 material, There's hey, here it is, just taking his time. So under the unit 15, there's some practice quizzes. There's going to be some math in that. But you also have, here it is, unit 14 and 15 math. So there's discount points, there's loan origination fee, there's all the math that we talked about last week, plus what we talked about this week. And at the very end is qualifying a buyer. So I give you extra practice on both finding the ratio, the monthly expenses, and the monthly income. And of course, the solutions are in here as well, but studying the solutions isn't going to do you any good. Work it yourself. Questions? We finally get to go to closing. We have been building up to this. We've created agency. We've determined how agency works. We put our buyers and sellers under contract. We got our buyers approved for a loan. Guess what? We're under contract, and now we get to work through the contract to closing process. And that's where we are in unit 21, is on closing the real estate transaction. So our roadmap in unit 21, we're going to talk about some pre-closing procedures. We've already talked a lot about this, so this will be a nice quick review for us. We're going to talk a little bit more about TRID, specifically the R in TRID. We've talked about the T, so now we need to talk about the R, our RESPA. And the star of unit 21 is what I refer to as a mini settlement statement. We are going to answer the question, how much does your buyer have to bring to closing? So we need to look at all the parties' debits and all of the parties' credits, so you can help your buyer determine how much they need to bring to closing. We have a duty to review these things for accuracy. Y'all remember Old Car? You remember the A in Old Car? We're helping our clients account for their funds, account for their money. So they don't know how to calculate these settlement statements, you guys. That's why they have us. And what we're doing here is briefly introducing you to the idea. That's why we call it a mini settlement statement. When you get to post-licensing, you're going to do a full-blown settlement statement. We're just easing you in. We obviously won't get to this math part today, so we'll get there on Thursday. Specifically, if I could get you guys, it's so important for you guys to look ahead 561 and 562. 561 and 562. That's kind of our formula for these mini settlement statements. What are the things that are typically debits to the seller? What are the things that are typically debits to the buyer? Credits to the seller and credits to the buyer. So that's where we're heading. And this is the math we'll get to do on Thursday. Before we pick up our calculator, though, let's talk about this contract to closing process. When I'm working with buyers and sellers, I always explain the contract to closing process as working gears. Let's put all the parties involved in this contract to closing process on a gear. So the listing agent, the seller get a gear, the buyer's agent, the buyer get a gear, the lender gets a gear, the appraiser, the home inspector, the surveyor, who else? The pest inspector. All these people that are involved in the contract to closing process gets a gear. What happens if one of these gears stops? Just one. Doesn't the whole thing stop? Keeping these gears going is a big part of our job. Keeping these gears going, keeping the buyer doing what they need to do, the seller doing what they need to do, the lender, the attorney, the home inspector, keeping these gears moving is a huge part of our job, as we are all working towards that goal of settlement, that goal of closing. So this process kind of starts with the pre-closing. Remember in unit 10, we looked at your offer to purchase and contract, your standard offer to purchase and contract. And we decided there was a difference between settlement and closing. You have a refresher of that in your book on page 518. Settlement is what we all attend. We go to the attorney's office for the buyers and sellers to sign all that document. If either party has to bring money, that's when they take it as settlement. Once that's done, we all leave settlement and the attorney finishes with the process of closing. And the very last act, the very last thing to happen is the attorney records the buyer's brand new deed. Once that happens, we can no longer call him the buyer, can we? Once that deed's recorded, they are now the homeowner. Then and only then is it a done deal. So understanding that difference of settlement versus closing. Some procedures going off book for just a second. We discussed that the buyer hires the closing attorney. The closing attorney, everything they do is in the best interest of the buyer. So the closing attorney does that title search. They offer their title opinion to get title insurance, all that we talked about in unit 5. If there's a blemish in the title search, the attorney will get with the seller to clear that up. The attorney's responsibility is to make sure that they hand their buyer client clear marketable title. That's their job, to get their buyer client clear marketable title. When the buyer comes with a lender, the attorney represents the lender as well. If it's a cash buyer, we're just going to represent the buyer. But when the buyer comes with a lender, the attorney represents the buyer and their lender. Like we just said, the very last act of closing is the attorney recording the buyer's brand new deed. You know what they do in the very next breath? They record the lender's deed of trust. All that usually happens before the buyer gets their keys. They don't have access to the property yet, but they already got a lien. In homeownership grand. Is the lender want to protect their interest? Better believe it. They just gave you 80% of your household value, or 90 or whatever. As a buyer's agent, you get your buyer and seller under contract. You have acceptance and you have communication of acceptance. I'm all about doing the mini celebrations to get to the big dance. Getting buyer and seller under contract deserves a mini celebration. Yeah, celebration over. We'll do the big celebration when this thing's closed. Getting them under contract is step 1. Buyer's agents, one of the very first thing I need you to do is send a copy of that contract to the lender, and then you send a copy of that contract to the attorney. We got to get both of them started on their thing. We got to get closing scheduled with the attorney, and we got to get the lender starting on the contract to closing process. So I hear you. Julie, what about me? When do I get paid? I want my money. Nobody gets paid until it closes. What's the very last act of closing? Recording the buyer's new deed. Do not go to settlement and ask the attorney, can I go ahead and have my check? They can't. There's laws out there because there's no money to give you your check yet. That's what the attorney finalizes in that act of closing. So we go to the attorney's office with our buyers or sellers. We leave, the attorney does their thing. And then you as agents get an email. And it's my favorite email in this industry. It's short, sweet, and to the point. You know what it says? We are on record. That's how you know it's a done deal. That's how you know you can go back and get your money. We are on record. Short, sweet, to the point, isn't it? Y'all want to know my second favorite email in this industry? It's from the lender. It's a couple days before closing or sometime before closing. Again, short, simple, and to the point. You know what the lender tells you? Clear to close. Clear to close means you've gotten loan approval. All you got to do now is go to the attorney and sign and finalize. Then you get the email that says, we are on record. That is when you do the major celebration. We are on record. When I was heavy in sales, whenever I had a closing, I always took my husband out for a fancy dinner because I figured he might have suffered along with me at some point too. So I take him out for a nice dinner somewhere. We celebrated. Heck yeah. Is it legal to use an attorney that you normally work with? Absolutely. As the buyer's agent, buyers are looking at me. They don't know closing attorneys. So buyers look at me and say, who do you recommend I use? And I can make recommendations. They say to give 2 or 3 names, give them choices. Do not send your buyer to Google to look for an attorney. You know what they're going to find in Google? Maybe crap. So they're looking at you to help. So once you form a relationship with an attorney, you can recommend. Let's say I give my buyer the name of 3 attorneys. Do they have to use anybody I recommend? No, it's their attorney, you guys. They can use whatever they want to. So we absolutely are going to give recommendations. Ultimately, they can use whoever they want to. So on back to page 519. 519 over to 520. You guys see that italicized? This is all verbiage straight from the offer to purchase and contract. Again, I always recommend you go to the form itself for the most current. I don't know if 519 and 520 are out of date or not, but what I do know is the most current is in the offer to purchase and contract that's in the online learning system. So as a reminder, the buyer's due diligence process is their opportunity to learn as much about the property as they possibly can. And then decide, now knowing what I know, do I want to terminate this transaction and get my earnest money back? Or do I want to move forward and purchase? Still nothing's a guarantee, but once they do their investigations, they have a decision to make. Now knowing what I know, do I want to move forward with this transaction or do I want to terminate? Starting on 520 then, we take the buyer's due diligence process and kind of break down the various things. Again, this also comes from our offer to purchase and contract, so we've seen these. But this just gives us an explanation, a better idea of the things that we should encourage the buyer to do during their due diligence process. If the buyer's getting a loan is like number 1 on their priority list. They need to call. I tell my buyers to call the lender back before you call me back, right? The lender has got to be their top priority, because if they don't get what they need, they can't go on with the loan process, and there's a good chance that closing will be delayed. So get your buyers going on that loan process. Talk to them about the importance of getting the lender the paperwork they need. We also want to encourage our buyer to do property investigations. These are any desired inspections or tests or surveys, anything they want to learn about. Anything of the property investigation is going to be at the buyer's expense. The whole point of due diligence is for them to learn as much about the property as they possibly can. So if they're not getting inspections and investigations, what are they learning about the property? Does this make sense? So encouraging them to do these inspections and investigations. Also during due diligence, there were too many D's in that. During due diligence, we also need the buyer to secure homeowners insurance. If the buyer's getting a loan, homeowners insurance is required. Period. End of story. If it's a cash buyer, homeowners insurance is highly recommended. So if the buyer's getting a loan, we need to get them shopping on homeowners insurance because the lender has to approve the policy that they think that they're going to get. It's part of the process. So usually with my guys, once we get what the lender needs for the first round of underwriting, then I get them on homeowners insurance and I encourage them to shop around because like real estate agents and lenders, all homeowners insurance carriers, agencies are different. So have them shop around so they can have something to compare and contrast. Tell them to call Jake with State Farm. Tell them to call Flo with Progressive. Tell them to shop around. If you know some, you can give some recommendations, but they need something to compare and contrast. Remember, I got a question about a loan contingency. Remember, there are no built-in contingencies. Can the buyers agree to add? Can the parties agree to add a loan contingency? Sure. In which case, the buyer wouldn't be bound to buy if you didn't get loan approval. But please, you guys, there are no built-in contingencies unless the parties create one. We got them shopping around for homeowners insurance. Again, the lender has to approve it. The appraisal, if a lender's involved, the appraisal is required. The appraisal is actually for the lender. Remember that loan to value ratio? The appraisal helps the lender determine the value, sales price or appraised amount, whichever is less. So the appraisal is actually for the lender. They let the buyer pay for it, but it's actually for the benefit of the lender. If it's a cash buyer, they can choose if they want to get an appraisal or not. Our unit coming up, our appraisal unit coming up is unit 17, the next unit we're going to do. We'll talk about that tomorrow. Buyers with any type of land are encouraged to have a survey done. Not recommended, not required, I should say, not required, but highly recommended. So we talked about that survey in unit 4. If it's on an on-site septic system, we want to encourage the buyer to have the septic system inspected. Who remembers how many human heartbeats per bedroom allowed for an on-site septic system? Yeah, you guys got it. 2 human heartbeats per bedroom. Anything more than that could overload the system. So it is, if it is on an on-site septic system, again, we're recommending that they get a septic inspection. Wood destroying insect report is what we call the pest report. Have you guys ever heard of a pest report? The pest report or the pest inspection doesn't look for all pests. The pest inspection just looks for those that destroy wood. These little buggers can do some damage. Termites, powder post beetles, carpenter bees, those things that eat wood. Now, if the home inspector sees evidence of other pests, they will report that. But understand, the pest inspector is just looking for wood destroying insects. You have a sample wood destroying insect report on page 522. And you can see about halfway down, the pest inspector is looking for termites, powder, or evidence of termites, powder post beetle, borers. I don't know what those are, but they sound kind of scary. There's something that eat wood. The pest inspection is only required for VA loans. FHA loan is optional. Conventional loan is optional. Pest inspection is required. Part of the due diligence, once the buyers had their inspections and investigations done, they may ask the seller to do any repairs. Can the buyer ask the seller to do repairs? Can you ask? Sure. Is the seller under any obligation to do repairs? No, it's their right to say no, isn't it? If the seller says, no, I'm not fixing anything, I'm not even going to change a light bulb for you, the buyer now has a decision to make. Now knowing what I know, now knowing all of these repairs that I'm going to have to do when I buy, do I want to move forward with or terminate this transaction? If the seller does agree to do any repairs, even change a light bulb, y'all remember that one sentence in our contract that says its property is being sold in its current condition? The property is being sold in its current condition. So if the seller agrees to do anything, we have amended our contract. And we have a form. Don't worry, there's a form for that. So if the seller agrees to do anything, yeah, I'll change that light bulb. Is that leaving the property in its current condition? No, it's leaving the property in its condition with a brand new light bulb. You guys see what I'm saying? By doing that form, by having the seller complete that form and sign that form, they're now contractually obligated to change the light bulb and do whatever agreed upon repairs. The negotiations for repairs need to be agreed on in writing and signed by both parties while we're still in due diligence. The buyer needs to know going forward, they make that decision to go forward based on the seller's agreement to do repairs. And the buyer needs to know that the seller is contractually obligated before they decide to move forward. So the repairs have to be negotiated, agreed on, in writing and signed while we're still in due diligence. The repairs themselves don't have to be complete until prior to settlement. So we usually have a period of time between due diligence and settlement, whatever we negotiate. Don't have to do the repairs prior to settlement, but we gotta have them agreed on. The buyer's right to terminate is during the due diligence period. You'll remember they can terminate for any reason or no reason. They could have a really long home inspection report that lists everything wrong with the home and decide they don't want to deal with it. Guys, they literally could wake up the next day and say, nah, I don't want to buy this house. I'm going to change my mind. The buyer's due diligence is their right to terminate for any reason or no reason at all. We can get the buyer their earnest money back. If the buyer exercises their right to terminate, they just have to provide written notice to the seller that they're terminating. They don't have to tell the seller why. Maybe they want to share with that, maybe they don't. So they can terminate for any reason or no reason. Time is of the essence is a drop dead. Due diligence is the time is of the essence, which is a drop dead date and time. Our contract specifically says due diligence ends on this date at 5 p.m. Which means if the buyer terminates at 5:01, they are now in breach if they terminate for any reason, and we can't get them their earnest money back. So again, question comes in, how long for due diligence? How long? A lot of times it depends on the market. Where are you? How many home inspectors are in your market? How fast can you get them in? How busy are they? Right? So you form relationships, and you're going to form relationships with a home inspector. And you have a buyer going under contract, and you're going to be able to call your home inspector and say, when can you get out here? Might that affect how long your due diligence period is? If they say I'm booked 3 weeks out, then I know I need to get at least 3.5 weeks for due diligence. Does this make sense? So there is no set time. That's why it's all negotiable. And that's why it can vary from market to market. The other thing we've talked about, buyer during due diligence, up until the time of settlement, anytime the buyer walks in that front door or goes to that property, they're going to inspect the property. You know, the first time they go, they have their rose-colored glasses on, and they're not looking for cracks or torn carpet or anything like that. They're looking, how will this house fit my family dynamics? Can I see us doing Friday night game night here? Can I see us doing Sunday brunch here? Each time they go into the home, they see things the second time they didn't see the first time. Any of my former buyers on here familiar with what I'm speaking of? Every time you go into the home, you see something different that you didn't see before, right? So as buyer's agents, we want to encourage our buyers to see the property a couple times. You know, they may want to look at paint samples or measure for furniture or, you know, meet the home inspector, whatever. The very last physical inspection that the buyer is going to do is that final walkthrough. Because another important sentence in our contract, this property, no, it's not that one. Closing shall constitute total acceptance. So once the buyer signs at settlement, They're agreeing to take the property as it is at this moment. And if we don't do the final walkthrough, how do we know what it looks like at this moment? So we're doing physical inspections up until settlement. By the way, let me say something else real quick about the home inspector. Please understand and help your buyers understand. The home inspector's job is to go into the home and find all the problems. Their job is to go in there and point out the things that are wrong. Prepare your buyers for this. The home inspector is not going to give them a report telling them how lovely the home is that they're going to buy. It's going to sound bad if the buyers aren't prepared for it. They're going to think, my God, is there nothing good about this house? Guys, that's not the home inspector's job. Their job is to go in and point out all the problems. And when it comes to the home inspector, I tend to think of the home inspector as your general practitioner. When you guys go to the doctor once a year, they kind of do an overall scan, right? And if there's anything that raises a flag, then they're going to recommend you talk to a specialist. And that's kind of the same way with the home inspector. They're going in and looking for flags. And if they see an issue with electrical, they're going to recommend that you talk to an electrician. If they see an issue with plumbing, they're going to recommend that you talk to a plumbing. They're going to recommend that the buyer goes to a specialist, which hopefully can all be accomplished during due diligence. There's a lot that goes on. You know, I always think buyer's agent, we talked about listing agents, all their work is done up front before you ever see the property online. Buyer's agents, our work starts, our true work starts when the buyer says, this is it, let's write it up. Let's make an offer. And when that offer gets accepted, we've got to help our buyer get through that due diligence, get the home inspection, the pest inspection, and the survey, and all those other things that they want inspected. Get those on the book. Get it going. Keep those gears turning. Other things that the buyer may want to consider, we talked about the first 4 of these in Unit 20, our super scary environmental unit. Buyer may want to consider having a radon test. If the home was built prior to 1978, they may want to consider having a lead-based paint test. If there's concern of asbestos, they may want to have that, mold. If it's well water, they may want to consider having a water inspection. I've had buyers have a water inspection on public water. One buyer looked at me and she said, I'm a nurse. I know what's in our water. I want it tested. I said, all right, cool. As a buyer's agent, don't ever look at your buyer and say, oh, don't worry about that. It'll be fine. Are you the one buying this house? No. If it's important to my buyer, then it's important to me. And if they say, I want to have the public water tested, okie doke, let's do it. Also back in Unit 6, we talked about public versus private streets, helping the buyer verify if the streets are public or private. And if they are private, how are we going to maintain it? Is it part of your monthly HOA dues, or do they do a special assessment every time we got a pothole? So how are you going to maintain these private streets? So I do think you guys, 520 over to 523, it gives us a good list of things that the buyer should consider doing during their due diligence process. How are they going to make the decision whether or not they want to terminate or move forward if they haven't done any inspections and investigations? Doesn't this make sense? So we need to get them started on that early, so we have enough time within due diligence. And remember too, these lists are not inclusive. If there's something your buyer wants inspected, okay. If it's important to them, then it's important to me. It actually hurts me when I hear buyers saying that their agent looked at them and said, oh, don't worry about that. You don't need to worry about that. For some reason, they're worried about that. Aren't they the ones buying this house? Come on. Yes, whether or not the streets are private or public has to be maintained. That's why I said we're going to help our buyer verify that information. Buyer has more work to do when we go under contract than the seller. Remember, the seller's hard work was getting the home show ready, right? Getting the buyers in the door, getting it on the market. But there are a few issues that the seller has to worry about. Their number one issue is, can the buyer get financing? We need to keep the seller informed about the buyer's loan process. Remember our material facts? And one of those material facts is if the party is unable to complete the transaction. So if we find out your buyer's loan is iffy, is that something we need to disclose to the listing agent, to the seller? Yeah, if we find out you're not going to get loan approval, is that something we need to disclose? Communication is key, making sure everybody knows what's going on. The seller also gets a settlement statement. We're just going to kind of introduce you to the idea of this. Again, you'll see a full-blown settlement statement in post-licensing. But as a seller's agent, we also have a duty to help our seller verify that the money they're going to get from closing is accurate. Buyers and sellers don't know how to calculate these monies on the settlement statement. That's why they have us. Question comes in, if the buyer wants an extension on due diligence, the seller agrees. So let's stop right there. Is the seller obligated to give more time and due diligence? Let's say the buyer asks. There's no rule that says the buyer can't ask, but is the seller required to give more time? No. They can agree to or not. Can the seller ask for more money? So if you want more time, can the seller ask for more due diligence? And my answer to you is anything's negotiable. As a buyer's agent, I usually go into that conversation with, if you give me more time, we'll give you more money. Is that more apt to make the seller say yes? Maybe, depending on their timeline. So anything is negotiable, you guys, even once we're under contract. This is why we call it renegotiating. So we can ask for more time. Can the seller say, give me more money? Sure. The buyer they either agree to that or they don't. And I think that's what makes real estate so interesting, because every single transaction is different. The one you do today is not like the one you did yesterday, and it won't be like the one you do tomorrow, because you change that seller, you change that buyer, and you change that property every single time. Okay, 1 p.m. Thursday, 9 o'clock, we are going to get through Unit 21. And then before we're done on Thursday, we'll talk about what next week's going to look like. So y'all have a good day and a half. Let me know if I can answer any questions, and I will see you first thing Thursday morning, and we'll jump into 21. Let's see. If the seller thinks the buyer's loan will not go through, can they terminate, or they have to wait to see? They have to wait to see. If the seller terminates, they're in breach. So if it's iffy, it's not done yet, right? So the seller has to kind of wait until we get a definite, yeah, this isn't going to happen. And then the buyer will terminate, hopefully still within due diligence. Good. Breathe. Where is she? Breathe. What's the number one rule in real estate school? It's amazing. Don't do those short labor breaths. Big, deep breaths in through the nose, out through the mouth. There you go. Just easing it in. Of course.